Introduction. This audiobook is not just another cut-and-paste collection of Warren Buffett's famed shareholder letters, nor is it merely a set of charming anecdotes from his remarkable life. It is much more than that, a comprehensive and insightful exploration of how Buffett revolutionized the world of investing, turning it into both an art and a science. Through meticulous analysis and clear explanations, this audiobook unveils the core of Buffett's business perspective investing. It breaks down his unique system into actionable concepts, proven methods, and even delves into the mathematical principles guiding his decisions. Whether you are a seasoned investor or just beginning your journey, this audiobook provides the tools and understanding to adopt Buffett's disciplined approach to achieving long-term success in the financial world. A story of insight and discovery, learning Warren Buffett's secrets. How did Warren Buffett transform an initial investment of $105,000 into a fortune exceeding $20 billion? That question sparked my curiosity and became the foundation of this book. His approach is disarmingly simple, yet extraordinarily effective, rooted in two fundamental questions. 1. What businesses should I invest in? 2. At what price should I buy? Answering these questions requires a profound understanding of businesses and a sharp grasp of valuation, a combination that Warren has refined through decades of experience. Lessons from Warren's Christmas gifts. Christmas in the Buffett household wasn't just a celebration, it was an education. Warren had an extraordinary way of imparting life-changing lessons about investing. Each year, he would gift family members a check for $10,000. But the real gift wasn't the cash. It was what replaced it. Shares of companies he admired. From capital cities to Coca-Cola, Freddie Mac to ServiceMaster, these weren't just stocks. They were lessons in disguise. Warren was teaching us to look beyond the stock ticker to the companies themselves. Annual reports would arrive, dividend checks would flow in, and soon, monitoring these investments became a family ritual. The Wall Street Journal found a permanent home on the kitchen table, and our conversations often revolved around the businesses we now owned. Through these gifts, Warren revealed a cornerstone of his philosophy. Ignore the noise of the market. Instead, focus on understanding the businesses behind the stocks. He wasn't merely an investor, he was a connoisseur of consumer monopolies. These were businesses with strong brands, unique products, or loyal customer bases. Warren's genius was identifying these gems and waiting patiently for the right price to buy them. What stood out was his disdain for Wall Street hype. Stock charts, market trends, and expert predictions meant little to him. Instead, he focused on fundamentals, the intrinsic quality of a business and its long-term potential. Teaching the next generation. Warren's lessons weren't reserved for adults. One afternoon, he sat on the couch with a copy of the Wall Street Journal discussing investment ideas. When someone joked about stock tips, he suggested Pillsbury. His reasoning was simple yet brilliant. Pillsbury owned Häagen-Dazs, ice cream, and Burger King, businesses the family knew and loved. True to form, Warren's suggestion paid off handsomely. Pillsbury was later acquired at nearly double the price. This episode highlighted a key principle: invest in what you understand. Warren's ability to identify relatable, strong businesses made him a masterful teacher and investor. What this book offers. This book distills Warren Buffett's investment philosophy into two core areas. 1. The qualitative side. What makes a company worth owning? Learn how to spot exceptional businesses with strong competitive advantages. 2. The quantitative side. What's the right price to pay? Using simple tools like the Texas Instruments BA35 solar calculator will teach you how to determine a company's true value. With short, practical chapters, this book is designed to be accessible for readers at all levels. You'll also find a curated list of 54 companies Warren has invested in, some revealed here for the first time. But remember, the goal isn't to blindly follow his investments. It's to understand why they were made and how to apply the same principles. A journey to becoming an intelligent investor. Warren often says, investment is most intelligent when it is most businesslike. That's the heart of his philosophy, and by the end of this book, it will be yours too. Whether you're new to investing or looking to refine your approach, this book will guide you toward becoming, like Warren, an intelligent investor. So let's embark on this journey together. Prepare to discover a world where investing is not just profitable, it's fascinating. The Wisdom of Buffett, a journey into discipline and business perspective investing. Let me tell you a tale of two timeless forces, folly and discipline. These, my friends, are the twin pillars of Warren Buffett's philosophy of investing. Not his folly, mind you, but the folly of others, matched by his unyielding discipline. At the heart of Warren's success lies a simple truth. He commits capital only when the decision makes sense from a business perspective. It is this clarity of vision, this business perspective investing, that allows Warren to profit from the stock market's often erratic behavior. Let us explore this story step by step, for Warren's journey is not merely one of numbers, but also a testament to the human capacity for patience, foresight, and wisdom. Discipline in a sea of folly. Picture the scene, the stock market. That roaring sea of emotion is a place where fear and greed drive many to folly. When others panic as the Dow Jones Industrial Average plummets 508 points in a single day, Warren's discipline keeps him calm. While others scramble to sell, he surveys the chaos with the confidence of a seasoned sailor, buying when others flee. Conversely, when the market reaches euphoric heights, Warren's discipline restrains him from chasing overpriced investments. This steadfast approach, rooted in business fundamentals, not market hysteria, is the foundation of Warren's success. Over 32 years, his portfolio has produced an average annual return of 23.8%, making him one of the richest individuals in the world. Notably, he achieved this feat solely by investing, becoming the only billionaire on Forbes' list of the richest Americans to do so without creating or inheriting a business empire. The core of Buffett's philosophy. At the heart of Warren's investing strategy is the concept of intrinsic value, the cornerstone of his philosophy. What is intrinsic value? In its simplest form, it is the projected annual compounding rate of return that an investment will yield over time. Warren's discipline lies in his ability to calculate this value and only invest when the price of a business offers an attractive return. Imagine this. Warren finds a stock priced at $10 today. He projects that in 10 years the stock will be worth $50. Using simple math, he calculates that this investment would provide an annual compounding return of 17.46%. He then compares this potential return to other opportunities. If the 17.46% return outshines the alternatives, the investment makes business sense, and he commits. But here lies the deeper question. How does Warren predict the future earnings of a business to determine its intrinsic value? This, dear reader, is the crux of Buffett's strategy, the art and science of Warren's craft. The power of predictable earnings. Warren invests long-term only in businesses with predictable earnings. To him, uncertainty in future earnings equates to risk, and risk leads to speculation, a dangerous path to folly. By focusing on companies with stable, consistent earnings, Warren removes much of the guesswork and builds his investments on a solid foundation. These businesses often share key traits. 1. High returns on shareholder equity. 2. Strong and consistent earnings. 3. A consumer monopoly, meaning a strong market position or brand loyalty. 4. Management that prioritizes shareholders' interests. The secrets of pricing and patience. Price, as Warren often says, is what you pay, value is what you get. The price of a business directly impacts the return on investment. A lower price means a higher return, while a higher price diminishes potential gains. This is why Warren is patient. He identifies excellent businesses but waits until the price is right, much like waiting for the perfect wave to ride to shore. Warren's knack for patience can be likened to high school romance. Imagine spotting someone you wish to date, but waiting for the opportune moment, perhaps after they've ended another relationship, before making your move. It's this disciplined waiting game that sets Warren apart from the herd. Beyond stocks, the bigger picture. While Warren is best known for his stock market investments, his portfolio is diverse. He prefers to buy entire businesses when possible, ensuring complete control. When this isn't feasible, he makes long-term investments in companies with strong fundamentals. But Warren doesn't shy away from other opportunities, dabbling in arbitrage and income securities as well. Each type of investment adheres to his central philosophy. The business must make sense, and the price must offer a strong return. 7 secrets of Buffett's success. If I were to distill Warren's approach into 7 guiding principles, they would be: 1. Invest long-term only in businesses with predictable future earnings. 2. Favor companies with excellent business economics that generate strong returns. 3. Look for a consumer monopoly and shareholder-focused management. 4. Pay the right price, low enough to ensure an attractive return. 5. Choose the business first. Let the price dictate the timing. 6. Aim for an annual compounding return of 15% or better over the long term. 7. Use other people's money wisely through partnerships or insurance investments to amplify returns. The path to Buffett's strategy. As we journey through this book, I will guide you through Warren's methods step by step. We'll explore how he calculates intrinsic value, identifies businesses with predictable earnings, and evaluates investment opportunities. You'll learn the tools and mindset necessary to emulate Warren's discipline, turning the folly of the market into your advantage. Remember, wealth isn't built overnight. Warren's success is a testament to the power of consistent, above-average returns over time. With patience, discipline, and the lessons in this book, you too can embark on the path to financial success. Let us begin this adventure into the world of Buffett's strategy. Together, we'll uncover the secrets of investing with wisdom, foresight, and unwavering discipline. The story of Warren Buffett and Benjamin Graham. Lessons in investment philosophy. In the bustling halls of Columbia University, a young Warren Buffett sat mesmerized as Benjamin Graham, a man often regarded as the high priest of investment wisdom, lectured with the quiet authority of someone who had spent a lifetime mastering his craft. Graham, the stately author of Security Analysis, was no ordinary professor. His words held the weight of experience, and his insights into the world of investing were as timeless as they were profound. It was here that Warren first encountered the idea that would shape his life. Investment is most intelligent when it is most businesslike. Graham wasn't just teaching numbers or strategies, he was imparting a philosophy. Investing, he argued, wasn't about gambling or guesswork. It was about thinking like a business owner, approaching every decision with reason and discipline. For Warren, this principle wasn't just a lesson, it became a credo. The seeds of an empire. Armed with Graham's wisdom, Warren began his journey in 1957 by forming an investment partnership with $105,000 pooled from family and friends. That modest sum grew into a financial empire now valued at over $20 billion. While others chased market trends or followed the herd, Warren stood apart, guided by Graham's principle of investing with a business perspective. But what truly set Warren apart wasn't just that he followed Graham, it was that he built upon his mentor's foundation. Graham gave Warren the tools, but Warren sharpened and expanded them, creating an entirely new approach to investing that transcended its origins. A synthesis of great minds. Warren Buffett's investment philosophy is often misunderstood as simply an extension of Graham's work. In reality, it is a synthesis of ideas from a pantheon of thinkers. From Benjamin Graham, Warren adopted the principle of buying undervalued stocks with a margin of safety. From Philip Fisher, he learned to prioritize businesses with excellent economics and to hold them for the long term, sometimes forever. From Lawrence Bloomberg, Warren gained insight into the enduring value of consumer monopolies. From John Burr Williams, he embraced the notion that a business's worth is tied to its future earnings. From John Maynard Keynes, he absorbed the importance of a concentrated portfolio and focusing deeply on one's area of expertise. From Edgar Smith, he recognized the power of retained earnings in compounding wealth over time. From Charlie Munger, his friend and partner, he adopted a more sophisticated approach to selecting great businesses at reasonable prices. Each of these influences contributed to Warren's evolution as an investor, but what made him exceptional was his ability to blend them into a cohesive strategy that worked in the real world. A departure from pure Grahamian philosophy. The contrast between Warren's approach and the pure Grahamian style is striking. Walter Schloss, another disciple of Graham, exemplifies the traditional method. Schloss manages a large, diversified portfolio, focusing on buying stocks below their intrinsic value and selling them as soon as they reach it. While effective, this approach often incurs taxes and misses the long-term benefits of owning truly great businesses. Warren, in contrast, runs a concentrated portfolio. For him, price is only one piece of the puzzle. Equally important is the quality of the business itself, its ability to generate consistent earnings and grow over time. Warren's willingness to hold stocks indefinitely allows him to reap the rewards of compounding without eroding his gains through taxes. The timeless lessons of Graham. At the heart of Warren's philosophy lies a profound respect for Benjamin Graham's teachings. Graham's security analysis isn't just a textbook, it's a timeless guide filled with lessons that remain relevant decades after they were written. Warren famously vowed not to make another investment until he had read Graham's book 12 times. Even today, he keeps all 4 editions within arm's reach, discovering new insights with each reading. For Graham, investing was about more than making money. It was about creating a legacy. He planted seeds of knowledge so that future generations could sit under the shade of the trees he nurtured. Warren Buffett is perhaps the greatest testament to that legacy, a living embodiment of Graham's principles, adapted and refined for a new era. The beginning of your journey. If you aspire to understand Warren Buffett's success, begin where he began, with Benjamin Graham's timeless philosophy. As we delve into the principles that have guided Warren's journey, remember this: great investing is not about complexity. It is about clarity, discipline, and the courage to think independently. This is the essence of Buffett's strategy, and it all starts with Graham's foundational idea. Investment is most intelligent when it is most businesslike. Let this be your guiding light as you embark on your own journey in the world of investing. The 2 paths of investing, choosing wisdom over folly in a Wall Street world. Once upon a time, in the bustling heart of the financial world, there lived 2 kinds of investors. The first group followed the booming echoes of Wall Street, chasing fleeting trends and whispers of stock prices soaring high. They clung tightly to their hopes, driven by a whirlwind of fear and greed. The second group, however, chose a path less traveled, a quieter, more disciplined route that viewed investing not as a game of luck, but as a deliberate business venture. This latter path was paved with wisdom, patience, and a steadfast understanding of value. To walk this second path required courage, for it demanded a mindset starkly different from the Wall Street folklore that captivated so many. It was not about guessing where the market would go tomorrow or betting on quick wins. No, it was about seeing investing through the eyes of a business owner, buying partial interests in companies when the numbers made sense, not when the crowd cheered. This business perspective, though profound, was not easy to adopt. It required knowledge of finance and accounting, yes, but even more so, it demanded discipline, a quality far harder to cultivate than knowledge. As the old saying went, knowing is half the battle, but doing is the other, and far more challenging half. This discipline was an unyielding guide, a voice of reason that often said, "Not yet, not now." Those who embraced this perspective learned truths that seemed almost counterintuitive at first. They waited patiently for markets to dip, understanding that downturns presented the best opportunities to acquire great businesses at a discount. They scoffed at the common folly of buying stocks simply because prices were climbing. They saw this for what it was, a game for gamblers, not investors. Instead, they focused on businesses with the potential to compound their wealth steadily over years, aiming for returns that others dismissed as too slow or boring. Diversification, the darling of many a financial advisor, also took on a new meaning. To these disciplined investors, diversification wasn't a mark of savvy, but a safety net for those unsure of their decisions. The truly disciplined investor concentrated their resources on a few well-understood opportunities, much like a craftsman who focuses on honing one perfect blade rather than churning out dozens of mediocre ones. Even the mundane act of shopping could spark revelations for these investors. A trip to the supermarket might unveil a company quietly dominating its market, overlooked by others, distracted by flashy trends. Wisdom, they realized, was often found in the ordinary, not in the dazzling promises of Wall Street brokers or the wild optimism of the market pundits. Perhaps most challenging of all, they learned to shed their attachment to stock prices as mere numbers. A $1,500 stock, they discovered, could be a bargain if it belonged to a great business with a robust future, while a $2 stock might be a trap. They began to think of stocks as bonds with variable interest rates, each tied to the underlying business's performance rather than market speculation. This journey of understanding was not without its mentors. Chief among them was Benjamin Graham, the father of value investing, who taught that investment was most intelligent when it was most businesslike. But it was Warren Buffett who took Graham's lessons and crafted something new. Warren, influenced by the thoughtful insights of Philip Fisher and the sharp intellect of Charlie Munger, refined and evolved Graham's principles. He realized that while Graham sought value in its purest form, buying assets at a significant discount, there was another layer to explore: the value of great businesses capable of sustained growth. Buffett's approach was not a rejection of Graham, but a transformation, a conflagration of clarity that illuminated a new way forward. He sought companies with strong competitive advantages, capable management, and the potential to grow profits consistently over time. In his eyes, investing was no longer just about avoiding mistakes, but about seizing opportunities to partner with exceptional businesses. And so, the stage was set for us to explore this philosophy in depth. We will travel back to the roots of these ideas, studying how Graham's teachings laid the foundation and how Buffett's revolutionary thinking built upon it. Along the way, we'll uncover the wisdom that can turn the mistakes of others, born from fear and greed, into opportunities for those who approach investing with discipline and a business-like perspective. Let us begin this journey, armed with curiosity and a commitment to think differently, for the rewards of this disciplined path are not just financial but intellectual, a mastery of principles that endure far beyond the fleeting whims of the market. Investment is most intelligent when it is most businesslike, a story and a lesson. Once upon a time, in the bustling city of Financialville, there lived two investors, Sam and Warren. Sam was the kind of person who spent his mornings glued to stock tickers, watching the numbers rise and fall like a horse race. Every day, Sam's stockbroker would call him with enthusiastic updates. "Sam, XYZ stock just shot up 3 points this week. It's hot! Buy it now!" The broker would exclaim, and Sam, feeling the rush of excitement, would scramble to buy the stock, hoping to sell it for a quick profit. To Sam, the stock market was like a casino, fast, thrilling, and unpredictable. But Warren, who lived just down the road, had a very different approach. Warren understood something Sam didn't. A stock is not just a number. It represents ownership in a real business. Warren treated the stock market not like a casino, but like a marketplace for buying pieces of businesses. The lesson begins: a visit to the drugstore. One day, Warren invited Sam to visit a local corner drugstore. "Let's pretend I'm offering to sell you this business," Warren said. Sam looked puzzled. "A drugstore? What does that have to do with stocks?" "Everything," replied Warren. "Let's look at this drugstore the way you should look at any investment." First, Warren opened the accountant's books. "Here's what matters," he said. "How much money does this business make each year? Let's say it earns $20,000 annually." Sam nodded. "Okay, what's next?" "Next, we ask if the earnings are reliable. Have they been consistent over time, or do they jump around? If they're steady, we can be more confident about the future." "And then?" Sam asked. "Well," Warren smiled, "now we need to know the asking price for the business. Let's say it's $100,000. If the business earns $20,000 a year, your return on investment would be 20%. Sam did some quick math in his head. 20%! That's pretty good. "Exactly," Warren replied. "The next step is comparison shopping. Is 20% a better return than you could get somewhere else? If it is, you'd buy the business. And here's the key. You wouldn't buy it to flip it for a quick profit. You'd buy it because owning a good, steady business for years will make you far richer than chasing short-term gains. The stock market illusion. Sam scratched his head. But Warren, when my stockbroker tells me about XYZ stock moving up 3 points, isn't that the same thing? No, Warren said firmly. That's the stock market illusion. Wall Street wants you to think of stocks as numbers on a screen, something to buy today and sell tomorrow. But when you buy a stock, you're actually buying a piece of a business, just like this drugstore. Warren paused for a moment and continued. Let me explain it this way. If you bought the drugstore and someone offered you 35% more for it the next day, would you sell it? Of course, Sam said eagerly. That's a quick profit. Warren shook his head. That's where you'd go wrong. If the drugstore earns you a consistent 20% return every year, selling it for a one-time 35% gain would be short-sighted. Not only would you lose out on years of predictable income, but the IRS would also take a big chunk of your profits in taxes. Then you'd have to reinvest your money in another opportunity, and finding another reliable 20% return might not be so easy. Thinking like a business owner. Here's the difference, Warren explained. Wall Street cares about short-term wins because that's what keeps careers alive. But real investors, business-like investors, think long-term. They look at the actual economics of the businesses they own. Let me ask you this, Warren continued. If you owned this drugstore, would you sit around worrying about what someone else might pay for it tomorrow? Or would you focus on how much it's earning for you every year? I'd focus on the earnings, Sam admitted. Exactly. Warren exclaimed. Now apply that thinking to stocks. Stop worrying about their prices moving up and down every day. Start thinking of yourself as a part owner of the businesses those stocks represent. Focus on what those businesses earn and what they'll continue to earn. Warren's secret to success, Sam finally understood. So your secret is to buy good businesses, not just stocks. Correct, Warren said. I look for excellent businesses that I can buy at prices that make sense. Businesses that will give me the highest predictable returns with the least risk. And I hold on to them for a long time, just like any good business owner would. But how do you know when a business is good? Sam asked. Warren smiled. A good business is one that earns steady profits, has a strong future, and can continue to make money year after year, and a good price is one that allows me to earn a return that makes sense, like the 20% return on the drugstore. The moral of the story. Sam left Warren's house that day with a new perspective. He realized that treating stocks like a game of numbers was a mistake. Instead, he learned to approach investing as if he were buying entire businesses, looking at their earnings, stability, and price. From that day forward, Sam stopped chasing hot tips and short-term gains. He started asking himself two simple questions before every investment. 1. What is the business behind this stock? 2. On what terms am I buying it? And just like Warren, Sam began to think like a business owner, patient, focused, and wise. As Warren often said, investment is most intelligent when it is most businesslike, and Sam never forgot it. The Tale of Two Investors and the Power of Retained Earnings. Once upon a time in the bustling town of Prosperity, there lived two investors, Sam and Warren. Both were skilled at finding good businesses, but their views on investing were quite different. Sam, like most investors on Wall Street, had a simple rule. If I don't see the earnings as cash in my hand, they don't count. Every quarter, he eagerly awaited his dividend check, a symbol of success in his eyes. Warren, however, saw things differently. To him, when he bought shares in a company, he wasn't just buying pieces of paper to trade on the market. He was buying ownership in a real business. One day, the two friends invested in a company called Evergrow Enterprises. Each bought 100 shares. That year, the company earned $5 per share. Sam leaned back in his chair, calculator in hand, and sighed, "Well, unless they pay me a dividend, this $500 in earnings is meaningless." But Warren smiled. "Not meaningless at all," he said. "You see, if the company earned $500 and I own 100 shares, that's my $500, just like it's yours. The only question is, what should the company do with it?" Warren explained his perspective. The company can do two things with that $500. One, pay it out as a dividend, which would make you happy today, but would also mean you'd pay taxes on it and then figure out where to reinvest it. Two, reinvest it into growing the business, increasing its value and future earnings for us shareholders. Sam frowned. Why would I want them to keep my money? I know better how to invest it. Warren leaned forward, his eyes gleaming. But what if they can use that money to grow the company at a rate far higher than you or I could get elsewhere? If they can invest wisely, reinvested earnings make our ownership stake more valuable. The Berkshire Hathaway story. To prove his point, Warren shared a story about his company, Berkshire Hathaway. Back in the 1980s, Berkshire's stock was trading for around $500 a share. The company earned money year after year, but never paid a dividend. Wall Street scoffed, saying, "No dividend? No thanks." But you know what happened? Warren continued. I used those retained earnings to grow the company, making smart investments that earned an annual return of about 23 cents after taxes. Today, Berkshire Hathaway's stock is worth over $45,000 per share, all without ever paying a single dividend. Sam's jaw dropped. Wait! You mean the value of the stock went up because the company reinvested its earnings? Exactly, Warren nodded. By retaining earnings and putting them to work wisely, we created enormous value for our shareholders. The stock market eventually recognized that growth and rewarded it with a higher price. The role of management. Warren then told Sam a golden rule of investing. Management quality matters. Think about it, Warren said. When a company earns money, management has a responsibility to use it wisely. If they pay it out as dividends, that's fine. But if they choose to reinvest it, they must earn a good return on that money. He gave an example. If a company can earn 20% per year by reinvesting its earnings, why take the money out? On the other hand, if management wastes the earnings on poor decisions or grandiose projects, shareholders like us would be better off receiving a dividend and investing the money ourselves. The test is simple, Warren added. Would shareholders be better off investing the money elsewhere? If not, let the company keep it and grow. Stocks as businesses and bonds. At this point, Sam was starting to understand, but he still looked confused. But Warren, how do you know if the company will earn a good return? Warren smiled. That's where analysis comes in. I treat a stock like a bond with variable interest payments. Instead of receiving fixed interest, I calculate my return based on the company's earnings. He broke it down. If a company earns $2 per share and the stock price is $10, my annual rate of return is 20%, $2 or $10. The key is finding businesses with earnings that are predictable and consistent. Sam was stunned. You mean you think about stocks like they're businesses you're buying in full? Exactly, Warren said. If you were buying the local bakery, wouldn't you ask how much it earns each year and what price you're paying for it? Stocks work the same way. The price you pay determines your return, the investor's choice. Before they parted, Warren left Sam with one final lesson. As shareholders, we have a choice. We can take dividends now and deal with taxes and reinvestment headaches, or we can let a great company reinvest those earnings for us. If the company can earn a better return than we can, it's like planting seeds that grow into trees that bear more fruit every year. Sam scratched his head and grinned. I guess earnings really do belong to us shareholders, whether they're paid out or reinvested. The real magic is in how they're used. Warren nodded, pleased that his friend finally understood. The moral of the story. And so, dear reader, the lesson from Warren Buffett is this. View stocks as ownership in businesses and treat earnings as your own. Whether those earnings are paid out as dividends or reinvested depends on one thing. Can the company put them to work at a better rate than you can? If so, let the company grow your wealth over time, just like Warren did with Berkshire Hathaway. Invest wisely, and remember, patience and smart reinvestment are the true paths to prosperity. The price you pay, a lesson in returns. Imagine this. You're walking through a bustling market where all kinds of things are for sale. Fruits, gadgets, even promises for future rewards. Suddenly I stop you and say, I'll sell you something valuable. At the end of 1 year, I'll hand you $1,100 in cash. How much are you willing to pay me for that promise today? You pause. It's an interesting offer. If you give me $1,100 now, I continue, you'll get your money back a year later, but nothing extra. No profit, no return. You break even. You frown. That doesn't sound exciting. But I say, if you give me $1,000 now at the end of the year, when I give you $100, you'll have earned $100 in profit. That's a 10% return on your investment. Suddenly, it clicks. By paying less up front, you're getting a better rate of return, shopping around for better deals. Now you're no fool. You don't take the first deal that comes your way. So you decide to shop around. The local bank says, hey, if you give us $1,000 today, we'll pay you $1,007 in 1 year. That's a 7% return. You think back to my offer, 10%. My deal is clearly better. The moral of the story? The price you pay determines the return you get. If you paid me $150 instead of $1,000, your profit shrinks to $50 and your rate of return drops to 4.7%. Pay even less, say $950, and your profit grows to $150, giving you a higher return of 15.7%. Pay more, get less. Pay less, get more. Applying this to investments, this is the logic that Warren Buffett lives by. Let me explain it in his world of buying stocks. Say you find a company that earns $5 per share every year. The stock is currently priced at $25 per share. What does Warren see here? He sees a return of 20%. Why? Because for every $25 you invest, you're earning $5 each year. That's $5 per $25, 20%. Now, let's change the price. If you pay $40 per share for the same company, the return drops to 12.5%. If you pay just $10 per share, the return skyrockets to 50%, $5 or $10. The lesson is simple. The higher the price you pay, the lower your return. The lower the price, the greater your return. General Foods, a real-world example. Let's take a quick trip back to 1979, where Warren Buffett spotted a gem, General Foods. The company was earning $4.65 per share annually, and Buffett started buying the stock at an average price of $37 per share. Using his quick math, Warren calculated his rate of return. Annual earnings of $5.05, price of $37, 13.6%. That 13.6% earn looked great because U.S. government bonds were offering only 10% returns at the time. Warren projected that General Foods earnings would grow at 8.7% annually. By holding on to the stock, Warren believed two things would happen. 1, the earnings would grow steadily. 2, the stock price would rise because the market would recognize its value. And he was right. By 1984, General Foods' stock price had climbed to $54. Then in 1985, the company was bought by Philip Morris for a whopping $120 per share. Buffett earned a pre-tax annual return of 21%. Dash the takeaway. Here's what Warren Buffett teaches us. 1, the price you pay determines your rate of return. 2, to calculate this return, you need to predict the company's future earnings. Whenever you consider an investment, focus on these 3 key variables. 1, the company's yearly earnings per share. 2, the predictability of those earnings. 3, the price you're paying for the stock. By paying less for strong, growing earnings, you maximize your rate of return. Remember, pay less, get more. Pay more, get less. This idea isn't just for Wall Street analysts with fancy calculators. It's for anyone who wants to make smart financial decisions. So wear this lesson like a key around your neck and keep it close wherever you go. Understanding the basics of bonds, stocks, and corporations, a story of capital and commerce. Imagine yourself flipping through the pages of a book on investing and realizing that many people, even those who own stock, struggle to explain what a bond is, what it means to own stock, or even what a corporation truly represents. Not you, of course. You've got an inquisitive mind. Still, let's dive into a journey of understanding these concepts. The dawn of commerce. Long before the idea of investing took shape, human beings engaged in trade. In ancient Babylonia, under King Hammurabi, 1792 to 1750 BC, clay tablets recorded loans secured with dates, wine, and barley. Interest was paid in grain and silver, and these rudimentary financial agreements laid the groundwork for commerce as we know it. Fast forward to the adventurous merchants of Phoenicia and Greece. Imagine a Greek merchant dreaming of importing luxurious Indian silks. Without enough money for the venture, he partners with others, pooling their resources to charter a ship and hire a crew. Partnerships like these were the earliest forms of business organization, limited in scope and lasting only as long as the voyage. Now, picture Venice in the 1400s, a glittering hub of trade and wealth. Here, the concept of the corporation began to take shape. Joint stock companies were born, allowing groups of merchants to pool small investments into significant capital. With this model, they could finance grand ventures, creating wealth and opportunities far beyond what a single merchant could achieve alone. What makes a corporation special? Let's fast forward to your own venture. You've decided to start Katie's Baking Company. Your sister invests $5,000 and you match her with another $5,000. Together, you incorporate your business, filing documents that transform your partnership into a corporation. Why? Because incorporation comes with unique advantages. 1. Limited liability. If a customer sues after biting into a bad cookie, the claim is limited to the company's assets. Your personal savings are safe. 2. Flexible ownership. You and your sister own 50 shares each, equal slices of the ownership pie. Need more money? You can sell additional shares, though that dilutes your ownership. This flexibility makes corporations attractive to investors and essential for large ventures. Bonds versus stocks. Now, Katie's Baking Company is thriving. You want to expand, but the bakery needs more cash. Here's where you face a choice. 1. Borrow money. Issue bonds. A bond is a promise to repay borrowed money with interest. It's like asking a bank for a loan, but on a larger scale. You approach an investment bank like Merrill Lynch to issue bonds. Investors who buy your bonds are essentially lending you money in exchange for fixed interest payments and the promise of repayment at a later date. Number 2. Sell ownership. Issue stock. Selling stock means selling pieces of ownership in your company. Let's say you sell 100 new shares. Now there are 200 shares total, and your original 50 shares represent only 25% ownership instead of 50%. But you've raised the money needed to grow. The rise of stock markets. Imagine this. Katie's Baking Company becomes wildly successful. Thousands of people want to invest. Merrill Lynch organizes an IPO, initial public offering, selling shares to the public. Suddenly, your little bakery has thousands of shareholders, each owning a piece of your dream. But what if some shareholders want to sell their shares? Enter the stock market, a place where buyers and sellers trade ownership stakes. In modern times, this happens on platforms like the New York Stock Exchange. Picture it as an auction where a buyer's bid meets a seller's asking price, facilitated by a matchmaker called a market maker. The financial power of the masses. In ancient times, savings often sat idle, buried or hidden. Today, banks and corporations unlock this capital. When you deposit money in a bank, the bank pools it with other deposits, lending it to businesses and individuals. Similarly, when you buy stock, you invest directly in a company's growth, sharing in its profits or losses. Through bonds, stocks and banking, even the smallest savers contribute to the vast engine of commerce, fueling growth and creating wealth. Lessons for the aspiring investor. As you ponder your role in this grand system, remember, bonds are promises to repay debt with interest. They represent security but limited potential for growth. Stocks are ownership stakes in a company. They carry more risk, but offer greater rewards if the business thrives. Corporations are remarkable entities that blend capital and innovation, enabling businesses to grow and protect their owners. Understanding these concepts is the first step to becoming a savvy investor, ready to navigate the financial markets with confidence and insight. Understanding Warren Buffett's investment philosophy. Now that we've laid some groundwork, let's dive deeper into Warren Buffett's investment philosophy, exploring it through the lens of a simple story. This will help us uncover key lessons while learning about fundamental business concepts like balance sheets, income statements, and valuation. Even if you're an MBA, don't fret. I'll sprinkle in nuggets of Buffett wisdom to keep things engaging. Young Warren and the birth of a business perspective. Imagine a young Warren Buffett at 17, determined to become America's richest man. With $35 saved from his paper route, he's itching to invest. He resists the temptations of fleeting pleasures, sweets, soda, or frivolous pursuits, and instead sets his sights on something that will grow his money. After some searching, he finds a used pinball machine for $35 and decides to turn it into a business. But where to place it? The local pool hall, already crowded with machines, denies him entry. Discouraged but not defeated, Warren notices that the pool hall's clientele, a group of pinball enthusiasts, frequent Sarge's barbershop for their crew cuts. This is Warren's aha moment. He approaches Sarge with a deal, a 20% revenue share in exchange for placing the pinball machine in the barbershop. Sarge agrees, and the venture begins. By the next day, the machine has earned $10. Warren hands $2 to Sarge and pockets $8, realizing he's onto something big. Analyzing Warren's first business. Let's examine Warren's new business from a financial perspective. On his first day, Warren's balance sheet looks like this. Balance sheet, assets. Cash, $8 from one day's profit. Property, $35. Value of the pinball machine. Liabilities, debt. Xerox holders' equity, paid-in capital, $35. Initial investment, retained earnings, $8. Total assets, total liabilities, plus stockholders' equity equals $43. The balance sheet gives us a snapshot of Warren's business on day one. Now let's look at his income statement, which shows his earnings for that day. Income statement. Revenues, $10. Expenses, $2 paid to Sarge. Net income, $8. This simple setup demonstrates how businesses track financial performance and position. But what's Warren's business really worth? Valuing Warren's business generates $8 in daily profits. With Sarge open 365 days a year, that's $2,920 annually. Over 10 years, the lifespan of the machine's location, the business could earn $29,200. Does this mean the business is worth $29,200 today? Not quite. Enter the concept of present value. Present value and investment returns. Future cash flows are worth less in today's dollars due to inflation and opportunity costs. To determine the business's present value, we discount those future earnings using an expected rate of return. If we assume an 8% annual return, the present value of Warren's 10-year income stream, $2,920 per year, equals $20,690.92. But what if you demand a 10% return given other investment opportunities like corporate bonds? At 10%, the present value drops to $17,163.07. This demonstrates a critical Buffett principle. Only pay what an investment is worth based on your required rate of return. Speculation versus investment. Warren teaches us to think like business people, not speculators. Speculators buy with hope, expecting prices to rise without analyzing intrinsic value. Investors, like Warren, evaluate the economic realities of a business. Take the cab driver who calculates his cab's cost versus expected earnings before buying. Contrast this with someone buying a classic car, hoping it appreciates in value. The cab driver acts on a business perspective. The car buyer speculates, applying the business perspective to the stock market. Buffett likens buying stocks to owning a piece of a business. Stock prices often fluctuate wildly due to speculation, fear and greed driving prices to extremes. But intrinsic value anchors a company's worth. In the 1988 RJR Nabisco buyout, management recognized the market had undervalued the stock due to fears of litigation. They leveraged their business perspective to orchestrate a buyout at a much higher valuation, proving the market's irrationality. Final takeaway: stick to economic reality. Buffett's philosophy boils down to this: invest in businesses with predictable cash flows, evaluate them from a business perspective, and demand a margin of safety. Speculators ride waves of hope and fear, but wise investors, like young Warren, ground their decisions in economic sense. The two most important questions: what to buy and at what price. Let's take a moment to simplify investing. If you can answer two basic questions, what to buy and at what price, you're well on your way to success. Sounds easy, right? But here's where it gets tricky. Wall Street, with its army of investment bankers, brokers, and analysts, operates more like a high-pressure sales team than a group of advisors. Their goal? To sell at the highest possible price. Investment banks want top dollar for new stock offerings so companies can raise more money and the banks themselves can pocket hefty commissions. Meanwhile, the brokers who call you up are paid commissions for every sale, so it's in their interest to push the priciest products they can. Here's how it usually works. If a broker pitches you a new stock offering, you can bet it's already been priced at its maximum by the investment bank. No bargains here. If the broker touts a stock backed by their research team, you're likely following the herd. The stock's price is probably climbing, and the broker's enthusiasm grows with it. You'll hear phrases like, "It's up 2 points today," or "The sky's the limit." They create urgency. "Better act fast. The train's leaving the station." But here's something fascinating. Warren Buffett operates with the exact opposite mindset. When prices rise, his enthusiasm wanes. The man who's made billions in investing refuses to chase the hype, unlike the brokers trying to sell you on the latest hot pick. The problem with ignoring price Wall Street often screws up the game by focusing solely on what to buy and ignoring the all-important at what price. They treat stocks like art or jewelry, emphasizing the aesthetics, the company's story, potential, or vision, while glossing over whether the price makes sense. Have you ever had a broker call you and say, "XYZ is a great company, but it's too expensive right now"? Probably not. Instead, they act as if a great company is a good buy at any price. But that's one of the dumbest mistakes you can make as an investor. The brokers aim to dazzle you with the company's potential, painting a picture so enticing that you can't resist. And like Pavlov's dog, you respond, handing over your money without ever asking the most critical question. Am I getting true value for my investment? Function over aesthetics. Warren Buffett approaches investing from a business perspective. His first concern isn't whether the stock price will rise, but whether the business itself will make money, and how much. Once he figures that out, he calculates whether the current price offers a reasonable return on investment. Wall Street, on the other hand, often sells speculative companies, businesses with no profits or predictable future, at sky-high prices. Meanwhile, solid companies with years of proven earnings are often overlooked and underpriced. Why? Because hype sells better than value. Graham's strategy is Warren's approach. Benjamin Graham, Buffett's mentor, believed the questions of what to buy and at what price were closely linked. For Graham, price dictated what to buy. If a stock was cheap enough, he'd buy it, regardless of the business's specifics. Think of it like finding a snowblower marked down from $259 to $25. Even if you live in Florida, the price is so good that you grab it. Graham had little concern for whether the business was manufacturing cars, selling insurance, or making batteries. As long as the price was far below its intrinsic value, he considered it a good buy. His focus was on finding a margin of safety, a built-in cushion between the price he paid and the value he believed the company held. Warren, however, does things differently. He separates the two questions. First, he decides what to buy. He identifies businesses he genuinely wants to own. Then he waits. Like a patient shopper, Warren only buys when the price makes sense. He doesn't wander into the discount store to browse for random bargains. Instead, he keeps a list of specific items he wants and only acts when they go on sale. Warren's key insight. Here's the lesson Warren teaches. 1. Decide what business you want to own. 2. Buy into it only when the price makes business sense. Warren's strategy is simple but powerful. He focuses first on the quality of the business and then on the price, ensuring he gets both value and return on investment. So, as you move forward, remember to keep these two questions front and center. What do you want to buy? At what price does it make sense to buy it? The rest of this story will guide you through how Warren answers these questions to achieve extraordinary success. Now, go back and read this once more. It's worth it. The magic of compounding, a key to Warren Buffett's success. Before we delve into Warren Buffett's investment strategy, it's important to first understand a foundational principle that plays a key role in his success, the power of compounding. Often regarded as one of the greatest phenomena in the financial world, Buffett's mastery of compounding is a central element of his approach. However, it is often overlooked or underestimated by those trying to understand his methods. What is compounding? Compounding occurs when the earnings from an investment are reinvested, generating additional earnings over time. This process causes the investment's value to grow at an increasing rate, with each period's growth building on the previous one. To demonstrate, let's look at a simple example. Imagine you start with just 1 penny, or 1. If you double its value every year, year 1, does 1 cent becomes 0.2. Year 2, 0.2 becomes 0.4. Year 3, 0.4 becomes 0.8. If you keep doubling for 27 years, your penny will grow into an incredible $1.3 million. This is the magic of compounding at an annual growth rate of 100%. While a 100% annual growth rate is extraordinary, even smaller growth percentages can have a profound effect over time. The table below shows how $100,000 grows over 10, 20, and 30 years at various annual compounding rates. The impact of just a few percentage points over time is astounding. At 20%, $100,000 becomes over $23 million in 30 years, more than 13 times what it would grow to at 10%. This explains why Buffett emphasizes maximizing the annual compounding rate of return. Why compounding is central to Buffett's philosophy. Buffett's goal isn't just to achieve average returns. His objective is to secure the highest possible compounding rate over the longest period. Through Berkshire Hathaway, Buffett has achieved an average annual compounding rate of 23.8% over 32 years, an exceptional achievement. To grasp the significance of this, consider how compounding rates influence long-term wealth accumulation. Buffett also avoids common mistakes, such as paying unnecessary taxing process. By investing in businesses that retain earnings rather than pay out dividends, he minimizes personal income taxes. These retained earnings stay within the company and compound over time at high rates. Tax implications, the Buffett advantage. Taxes can seriously hinder the effectiveness of compounding. Traditional investments like bonds are subject to annual taxes on the interest they earn. For example, if you invest $1,000 in a bond with an 8% annual yield, you earn $80 each year. The IRS taxes this income every year, which reduces the after-tax return to around 5.5% for a high-income investor. After 5 years, your after-tax earnings would be around $276. Now let's consider an alternative scenario. If the interest earned is reinvested instead of paid out, the principal grows each year, compounding at 8%. Taxes are deferred until the end of the investment period, significantly increasing the total return, as seen in the table below. After 5 years, the total grows to $469.31, which is a higher return than if taxes had been applied annually. Although the IRS usually taxes interest income yearly, Buffett takes advantage of equity investments where earnings compound tax-free until the investment is sold. The equity advantage Buffett views stocks as equity bonds, providing compounding returns without the annual tax burden associated with fixed income investments. As long as a company retains its earnings and reinvests them effectively, shareholders benefit from untaxed growth. When the stock is eventually sold, taxes are incurred, but until then, the compounding process continues uninterrupted. For example, if a company earns $10 per share after taxes and retains it, shareholders enjoy the full benefit of that $10 compounding within the company. If the company reinvests the profits effectively, the shareholders' effective rate of return increases over time, tax deferred. Why purchase price matters. Compounding works best when paired with a favorable purchase price. For instance, if you bought Philip Morris stock in 1987 for $6.07 per share and sold it in 1997 for $44, your annual compounding rate would be 21.9%. However, if you paid $10.36 per share in 1987, your annual return drops to 15.56%. This highlights the importance of buying investments at a fair or undervalued price. Conclusion: compounding and the long game. Buffett's brilliance lies in his disciplined approach to compounding. Maximize annual compounding rates by choosing businesses with strong reinvestable earnings. Minimize taxes by avoiding dividend-paying stocks and holding investments for long periods. Buy at the right price to enhance overall returns. The result? extraordinary wealth accumulation over decades. By applying compounding principles to your own investments, you can unlock the same magic to achieve your financial goals. As Buffett himself shows, compounding is not just a financial concept, it is a powerful tool for building lasting wealth. From bargains to greatness, an investor's journey to owning the ideal business. Once upon a time, there was a young investor named Alex who dreamed of owning a business that could grow and thrive for years to come. Alex spent countless days reading about the strategies of legendary investors, trying to unlock the secrets to building lasting wealth. Eventually, Alex stumbled upon the wisdom of three great minds: Benjamin Graham, Philip Fisher, and Charlie Munger. Each had a unique perspective on what made a business worth owning, and their lessons shaped Alex's understanding of what to look for in an ideal business. Graham's world. Bargains everywhere. Alex started with Graham's philosophy. Graham, known as the father of value investing, believed that many businesses had an intrinsic value, a true worth, that could be calculated. If a business's stock was selling for less than its intrinsic value, Graham considered it a bargain. He famously said that you didn't need to know a fat man's exact weight to recognize he was overweight. To identify these bargains, Graham devised methods to measure a company's financial health. For instance, he focused on businesses selling below their net current asset value or those with a price-to-earnings PE ratio under 7. Graham's approach worked well for Alex in the short term, providing consistent returns when prices rose to match intrinsic values. But Alex soon noticed a problem. Sometimes businesses didn't rise to their intrinsic value quickly, or ever. The longer Alex waited, the lower the annual return on the investment. If a stock stayed undervalued for years, the return could dwindle to almost nothing. Graham's solution was diversification, owning dozens or even hundreds of stocks to spread the risk, and strict timelines for selling stocks. Yet this approach left Alex holding investments that didn't perform, leading to frustration. The Fisher-Munger shift. Excellence over bargains. Frustrated by these limitations, Alex began studying the philosophies of Philip Fisher and Charlie Munger, who offered a different way of thinking. They believed that instead of buying any business at a bargain price, it was far better to invest in businesses with exceptional qualities, ones with superior economics working in their favor. Fisher taught Alex to look for businesses with the following characteristics. 1. Consistent growth. Companies that could expand year after year without losing momentum. 2. Competitive advantages. These might include a strong brand, unique products, or cost efficiencies that competitors couldn't easily replicate. 3. Outstanding management. Leaders who could skillfully navigate challenges and steer the business toward long-term success. Munger, Warren Buffett's close partner, expanded on these ideas. He emphasized investing in businesses with expanding value, companies that could compound earnings over decades. Munger's approach encouraged Alex to think about the quality of the business rather than just its price. Munger and Fisher both agreed it's better to own a great business for a long time than a mediocre one for a short time. Warren's lesson. Know what you want. Warren Buffett himself had started as a disciple of Graham, but he later adopted Fisher and Munger's approach, finding it more effective over the long haul. From Warren, Alex learned the importance of clarity. Before even considering a price, Alex needed to define the qualities of the business they wanted to own. Warren's ideal business had strong, predictable earnings, stability and growth in profits year after year, durable competitive advantages, something unique that kept the business ahead of rivals, great management, leaders who understood how to reinvest profits wisely, opportunities for reinvestment, businesses that could deploy earnings back into their operations to fuel further growth. The key insight: buy excellence, hold forever. Alex finally realized that the best businesses to own were not just those that were cheap, but those that could grow in value over time. If the business's underlying economics were excellent, the stock price would eventually reflect that value without needing to sell. Taxes wouldn't eat away at the returns because great businesses could compound wealth indefinitely. So Alex stopped looking for bargains and started searching for excellence. They found businesses with great products, loyal customers, and strong leadership. And instead of selling when the price went up, Alex held on, letting the value compound year after year. By following the teachings of Graham, Fisher, Munger, and Warren, Alex discovered that owning a business wasn't just about finding something cheap. It was about finding something worth owning forever. The lesson was clear. First, decide what you want in a business, and then determine if it's selling at a fair price. When you own something truly excellent, time becomes your ally, and wealth builds naturally. In the end, Alex's journey wasn't just about buying stocks. It was thinking like a business owner, seeking out greatness and letting it grow. The Wisdom of Value Investing. Lessons from Fisher, Munger, and Buffett. Once upon a time, two investing legends, Philip Fisher and Charlie Munger, unearthed a profound truth. Certain businesses possess a unique ability to grow their intrinsic value over time. These businesses, when managed well and enjoying favorable economics, have an expanding value that, even if initially overlooked by the stock market, will eventually be reflected in their rising stock prices. This insight represented a pivotal shift from the traditional value investing philosophy of Benjamin Graham. Graham taught that bargains could be found in the market by purchasing stocks below their intrinsic value, with the expectation that the market would soon recognize this discrepancy. However, Fisher and Munger saw something more enduring. They understood that businesses with excellent economics could grow their earnings consistently, causing their intrinsic value to rise regardless of short-term market behavior. The case of General Foods. Let's take a real-world example. General Foods, a company Warren Buffett invested in during the late 1970s. From 1979 to 1985, General Foods consistently increased its earnings per share. When Buffett started buying its stock in 1979, earnings were $5.12 per share, and the stock traded between $28 and $37. This represented a return of 13% to 18%, far exceeding the 10% return offered by government bonds at the time. Under Graham's approach, Buffett might have sold General Foods in 1981 when the stock price began to approach its intrinsic value. Or he might have exited in 1984 when the price hit $60. However, Buffett chose a different path. Guided by Fisher and Munger's principles, he recognized General Foods' potential for long-term growth. Even though the stock occasionally traded below its intrinsic value, Buffett understood that as the company's earnings grew, the market price would inevitably follow. Buffett's patience paid off when General Foods was acquired by Philip Morris in 1985, realizing significant gains for shareholders. This example demonstrates the power of focusing on excellent businesses with the ability to compound value over time. The shift in Buffett's thinking. Buffett's journey from a strict Grahamian approach to a Fisher-Munger-inspired philosophy was transformative. He discovered that businesses with mediocre economics, those that tread water rather than grow, rarely delivered meaningful long-term returns. Even when purchased at a discount, such businesses often remained lackluster, offering limited gains while exposing investors to the risk of deteriorating fundamentals. In contrast, businesses with superior economics, those capable of generating consistently growing earnings, had what Fisher and Munger described as expanding value. Buffett realized that investing in such businesses allowed him to 1. Harness compounding. Excellent businesses reinvest retained earnings to generate even greater future earnings, creating a compounding effect that amplifies returns over time. 2. Minimize taxes. By holding investments for the long term, Buffett avoided frequent capital gains taxes, further boosting his effective returns. 3. Reduce risk. Strong businesses with enduring competitive advantages, what Buffett calls moats, are better equipped to weather economic challenges, reducing the risk of permanent capital loss. Illustrating the power of excellent businesses. To illustrate the principle of expanding value, Buffett often cites his investments in companies like the Washington Post, GEICO, and Coca-Cola. Washington Post. In 1973, Buffett invested $9.7 million in the newspaper, holding his shares for decades. Over 24 years, the value of this investment grew to approximately $600 million, delivering an annual compounded return of 18.7%. Geico. Buffett purchased $45.7 million worth of Geico stock in the early 1970s. By 1995, this investment had ballooned to $1.76 billion, a compounded annual return of 17. Coca-Cola. A single $40 share of Coca-Cola purchased in 1919 would have grown to over $2.1 million by 1993 if all dividends were reinvested. This represents a compounded annual return of 15.8%. Each of these investments underscores the power of holding excellent businesses for the long term. Even when market prices occasionally exceeded intrinsic value, Buffett's commitment to these high-quality companies enabled him to reap the benefits of compounding over decades. The key takeaway: Buffett's evolution from Graham's bargain-hunting strategy to Fisher and Munger's focus on expanding value teaches a critical lesson. Time is the friend of the great business and the enemy of the mediocre. Mediocre businesses, no matter how cheaply acquired, rarely produce exceptional results. In contrast, excellent businesses, even if purchased at a fair price, can deliver extraordinary long-term returns through their ability to compound earnings and intrinsic value. By recognizing this, Buffett transformed his investing philosophy, building one of the most successful track records in history. His journey underscores the importance of focusing not just on price, but on the quality and growth potential of the underlying business. So, as aspiring investors, let us remember, the real magic happens when we identify and hold businesses with expanding value. And in the words of Buffett himself, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The Tale of Two Businesses, Warren Buffett's key insight. Once upon a time, there lived a wise investor named Warren. His success was no accident. It was the product of years of careful thought and disciplined practice. Among the many secrets of his success, one stood out. Warren discovered a way to tell the difference between two kinds of businesses. One was the rare, exceptional kind that yielded abundant rewards year after year. The other was the common, ordinary kind whose very nature doomed it to mediocre outcomes. To make sense of this, Warren divided the business world into two categories. One, the commodity-type business. These were businesses stuck in fierce competition, offering products where the lowest price was the only thing customers cared about. Two, the excellent business. These were the rare gems that Warren called consumer monopolies, which possessed unique characteristics that made them consistently profitable. Warren learned that the economics of consumer monopolies were superior. They delivered better results for their owners and often outperformed the stock market. But before we explore the excellent business, let us first understand the commodity-type business and why it often leaves investors disappointed. The struggles of the commodity-type business. Imagine a business that sells something everyone needs but nobody particularly cares about, like gas for your car, steel for a building, or the corn on your dinner table. These are commodity-type businesses, where the deciding factor for customers is price. Let's walk through their story. A price-driven market. In the world of commodities, brand loyalty is rare. Consumers rarely care whether their gas comes from one company or another, as long as it's the cheapest. The same applies to raw materials like lumber, paper, or foodstuffs. Even if companies spend millions on advertising to make their products seem different, in the end, the cheapest option wins. The vicious cycle of competition. Here's how it works. A company, let's call it Company A, finds a way to produce its product cheaper. It lowers prices to attract more customers. Competitors, companies B, C, and D, start losing sales. To survive, they must also lower their costs and prices. Soon, everyone is back at square one, with low prices and thin profit margins. The cycle repeats. Sometimes external factors like natural disasters briefly tilt the scales. For example, after a hurricane destroys homes, the price of building materials may skyrocket. But as supply catches up with demand, prices and profits fall again. Management versus industry economics. In a commodity business, success depends heavily on management's ability to cut costs and use assets efficiently. Even the smartest managers, however, face an uphill battle if the industry itself is locked in relentless price wars and slim profit margins. Warren often pointed to Burlington Industries, a textile company, to illustrate this. Despite excellent management and decades of effort, the company's stock barely grew over 21 years because of poor industry economics. Burlington invested billions to improve efficiency, yet fierce competition kept its profits low. Spotting a commodity-type business, Warren developed a keen eye for identifying commodity businesses, and you can too. Here are their telltale signs. 1. Low profit margins. Price wars mean these businesses rarely make big profits. 2. Low returns on equity. If returns are below the average of 12%, it's a red flag. 3. Lack of brand loyalty. Customers don't care who makes the product as long as it's cheap. 4. Many competitors. Multiple producers selling similar goods keep prices and profits down. Excess capacity. Industries with too much production capacity struggle to maintain profits. 6. Erratic profits. Profits often swing wildly with the economy or sudden changes in demand. 7. Dependence on tangible assets. These businesses rely heavily on physical assets like factories, rather than intangible ones like patents or strong brand names. For Warren, the final test was simple. If customers cared more about price than anything else, it was a commodity business, and one to avoid. Lessons for investors. The story of the commodity-type business is a cautionary tale for investors. While these businesses can sometimes deliver short-term gains, they rarely create long-term wealth. As Warren liked to say, when a business with a poor reputation meets a manager with a great reputation, it's usually the business that keeps its reputation intact. For those seeking enduring success, the next step is to explore consumer monopolies, the shining stars of Warren's portfolio. But that, dear reader, is a tale for another time. For now, remember, if price is the only thing that matters, steer clear. The economics of the business will likely keep it locked in mediocrity, no matter how hard management tries. The story of consumer monopolies, lessons from Warren Buffett's playbook. Imagine standing on the banks of a wide flowing river. You need to cross to the other side, but there's only one bridge. That bridge has a toll. If you want to cross, you have to pay the toll. It's as simple as that. The owner of that bridge has what Warren Buffett famously calls a consumer monopoly. This concept is at the heart of Warren's investment philosophy. His strategy isn't about chasing every shiny opportunity or jumping into the latest trends. Instead, Warren looks for companies with products or services that create consumer monopolies. These are businesses whose offerings are so unique, indispensable, or dominant that they hold a special place in their customers' minds and wallets. Understanding the consumer monopoly. Let's take the example of a newspaper in a large town. If it's the only newspaper available, advertisers have no choice but to pay whatever rates the paper sets if they want to reach the local audience. This exclusive position allows the newspaper to enjoy greater pricing freedom and, in turn, higher profits. The same principle applies to other businesses with consumer monopolies. Coca-Cola is a perfect example. No matter where you travel, whether it's a bustling city or a remote village, you'll likely find a Coca-Cola in every shop or restaurant. Why? Because it's so popular that businesses have to carry it. If they don't, they risk losing sales. The roots of consumer monopolies. The idea of consumer monopolies isn't new. In 1938, Lawrence N. Bloomberg, a doctoral student at Johns Hopkins University, explored this concept in a paper titled The Investment Value of Goodwill. He found that companies with strong consumer goodwill often had superior financial results. Bloomberg identified several factors that contribute to this goodwill: convenient locations, courteous employees, consistent product quality, persistent and memorable advertising. Unique offerings, like patented products or secret formulas, think Coca-Cola or Hershey's chocolate. These factors create a powerful connection between the consumer and the brand, making it hard for competitors to break in. Warren's test for a consumer monopoly. Warren developed a simple yet insightful test to identify a consumer monopoly. If he had unlimited money and access to the best managers, could he start a business that successfully competes with the one in question? If the answer is no, then that company likely has a strong consumer monopoly. Take Marlboro cigarettes, for example. Marlboro smokers are famously loyal to their brand. Even if you offered them a cheaper or better option, they'd likely stick with Marlboro or consider Coca-Cola. To compete with Coca-Cola, you'd need a fortune and decades to replicate its global reach, brand recognition, and consumer trust. And even then, success would be uncertain. Why consumer monopolies thrive? Companies with consumer monopolies enjoy several advantages. 1. Low competition. Without strong rivals, they don't need to constantly innovate or cut prices. 2. High margins. They can charge premium prices thanks to their unique position in the market. 3. Efficient use of capital. Unlike companies that require massive investments in factories and equipment, e.g. General Motors, these businesses rely on intangible assets like brand names or patented processes. 4. Debt-free growth. Many such companies generate enough cash flow to avoid taking on debt, giving them flexibility to reinvest or return money to shareholders. For instance, Wrigley, Chewin, and UST, chewing tobacco, operate with little to no debt. Their steady cash flows and minimal need for high-tech equipment allow them to dominate their markets efficiently. The Hidden Water Company. The challenge is that once the investment community recognizes these monopolies, their stock prices often skyrocket, making them expensive to buy. The key, then, is to find a business that operates like a monopoly but isn't yet priced as one. Warren refers to this as finding a disguised water company, a business with monopoly-like qualities but no regulatory constraints or sky-high valuations. Lessons from history. History is full of examples of consumer monopolies. The Venetians dominated trade with the Far East, leveraging their exclusive position for immense profits. Colt and Winchester became synonymous with quality firearms in the American West. General Electric, founded by Thomas Edison, revolutionized the electrical industry and profited immensely by selling everything from power systems to appliances. These businesses thrived because they offered something unique and indispensable, creating lasting consumer goodwill. Applying the lesson. As investors, the takeaway is clear. Look for businesses with strong consumer monopolies. These companies are often resilient, profitable, and capable of delivering superior long-term returns. Whether it's Coca-Cola, Wrigley, or Marlboro, these brands demonstrate the enduring power of a consumer monopoly. So next time you reach for your favorite soda or your trusted brand of chocolate, think about this. The company behind it might just be the kind of exceptional business Warren Buffett loves to own. And that's a lesson worth remembering. The Nature of the Beast, Learning to Spot Excellence, 9 Key Questions to Assess the Excellence of a Business. Imagine yourself as a hunter, not of game but of greatness. You're tracking an elusive creature, one Warren Buffett himself has studied for decades. This beast is the excellent business, a rare and valuable find in the world of investing. To identify it, Warren has uncovered certain characteristics that help separate the exceptional from the ordinary. But how do we begin this pursuit? The process, Warren advises, is not unlike asking a series of insightful questions on a first date, questions that reveal whether this partnership is worth committing to for life. Just as one might ask about past relationships, life goals, or quirks, snoring, we use these inquiries to uncover whether a business is truly extraordinary. Here are 9 essential questions to guide our journey. 1. Does the business have an identifiable consumer monopoly? 2. Are the company's earnings strong and trending upward? 3. Is the company conservatively financed? 4. Does the business consistently earn a high return on shareholders' equity? 5. Does the business get to retain its earnings? 6. How much does the business spend maintaining its current operations? 7. Can the company reinvest its retained earnings effectively? 8. Is the business free to adjust prices to inflation? 9. Will retained earnings increase the company's market value? These questions are our map, each one offering a glimpse into the nature of the beast we seek. Let's unpack them together. 1. Does the business have an identifiable consumer monopoly? At the heart of an exceptional business is often a consumer monopoly, something that acts as a toll bridge for customers. This monopoly could be a brand so entrenched in our lives that we can't imagine living without it. Think Coca-Cola, Marlboro, Disney, or Hershey. To find a consumer monopoly, take a walk through your local supermarket or convenience store. Look for the products that seem indispensable. What would be unimaginable for the store not to carry? Coca-Cola, for instance, is available nearly everywhere on the planet. Such products don't just fill shelves, they dominate their space. Services can be trickier to spot, but think of credit card companies, television networks, or advertising agencies. These businesses often hold monopolies in their own niches. However, a consumer monopoly alone doesn't make a business excellent. Management must turn this advantage into consistent value for shareholders. 2. Are the earnings strong and trending upward? A business may have a monopoly, but if its earnings fluctuate wildly, it may not be well run. Warren looks for earnings that are not only strong but steadily rising. Imagine two companies, Company 1 and Company 2. Company 1 has a consistent upward trend in earnings, while Company 2's earnings swing unpredictably. Warren would favor Company 1. Predictability and growth in earnings reflect strong management and sound operations. 3. Is the company conservatively financed? A hallmark of an excellent business is minimal reliance on long-term debt. Companies with consumer monopolies often generate so much cash that they don't need heavy borrowing. Consider this. A conservatively financed monopoly like Coca-Cola has less than 1 year's net earnings in long-term debt. Contrast that with companies burdened by debt used to acquire less profitable businesses. Warren's rule? When two consumer monopolies merge, the result is often fantastic. When a monopoly marries a commodity-type business, the outcome is usually mediocre at best. 4. Does the business consistently earn a high rate of return on shareholders' equity? Shareholders' equity is the company's assets minus its liabilities, essentially the owner's stake. Warren prizes businesses that earn consistently high returns on this equity, far above the average of 12% for American corporations. For example, Coca-Cola had a 33% return on equity when Warren began investing, and it maintained an average of 25% for years. These numbers signal not just good management, but the ability to reinvest profits effectively. 5. Does the business get to retain its earnings? What a company does with its profits is as important as how much it earns. Some businesses must spend most of their profits maintaining operations, while others reinvest in growth. Warren found exceptions to the rule. Certain businesses could retain earnings and use them to acquire new companies or expand their core operations, compounding shareholder value over time. These are the businesses we want to find. 6. How much does the business have to spend on maintaining current operations? Imagine a bakery that bakes delicious bread, earning $1 million a year. However, every 2 years, the bakery's oven, mixers, and other equipment need replacement, costing $2 million. Over time, the bakery isn't making real profits, it's simply staying afloat. In another town, there's a family-owned chocolate shop. They built their facilities decades ago and only require minor upkeep. Each year, they generate $2 million and nearly all of it becomes profit. This chocolate shop has plenty of cash to grow or pay back its owners. Warren Buffett observed this distinction early in his career. He saw companies like AT&T, which earned a lot of money but spent even more on infrastructure and research, leaving little for shareholders. On the other hand, businesses like Thomson Publishing, which ran low-maintenance newspapers, thrived by needing minimal reinvestment and producing consistent profits. The lesson is clear. A business that requires constant reinvestment to stay operational is like a hamster on a wheel. It runs hard but gets nowhere. A great business can make money, keep it, and spend little to maintain its operations. Look for investments where cash flows freely after necessary upkeep. 7. Is the company free to reinvest retained earnings into new opportunities? Young Warren Buffett once ran a pinball machine business. Instead of pocketing his profits, he bought more machines and placed them in different locations, multiplying his earnings. Had he simply saved the money in a drawer, it wouldn't have grown. Companies work the same way. Imagine two firms. Company A earns $10 million annually and invests it in high-return ventures, doubling its profits in 5 years. Company B, on the other hand, saves its earnings without reinvestment or invests in low-return projects. After 5 years, Company B's value stagnates. Warren identified that exceptional companies reinvest retained earnings into projects yielding high returns, or, if no such opportunities exist, buy back shares to boost shareholder value. For instance, Sara Lee and Philip Morris reinvested their earnings into acquiring other profitable brands, turning their cash cows into empires. When evaluating a company, ask, does it have opportunities to reinvest earnings at high rates of return? Does management wisely allocate capital? The answer determines whether the company can grow shareholder wealth or just tread water. 8. Is the company free to adjust prices to inflation? In a small town, there are 2 businesses, a boutique hotel and a wheat farm. The hotel raises its room prices every year to match inflation, and its customers continue to book rooms. The wheat farm, however, struggles because inflation raises its costs for seeds and equipment, but market competition prevents it from increasing the price of wheat. Warren saw this play out in industries like airlines and ranching. For example, airlines often face fierce price wars. Even as fuel, aircraft, and labor costs rise with inflation, they can't always raise ticket prices without losing customers. Meanwhile, businesses with pricing power, like a beloved chocolate company or a trusted brand of razors, can adjust prices without losing sales. A great business can pass inflation costs to its customers without reducing demand. This ensures that its profits remain steady even during economic turbulence. Businesses with pricing power have a significant advantage over their competitors. 9. Will retained earnings increase the company's market value? Imagine 2 sailors. One uses his spare time to repair his boat, upgrading its sails and equipment. Over the years, his boat becomes faster and more valuable. The other sailor spends his time gambling at the port. Though he occasionally wins, his boat remains unchanged. In the world of business, the first sailor represents companies that reinvest retained earnings wisely, leading to growth in both intrinsic and market value. Berkshire Hathaway is a prime example. Its net worth grew dramatically because Warren allocated earnings to profitable acquisitions. Over time, the stock price followed suit. On the other hand, a company whose stock price rises purely due to speculation is like a gambler in a casino, unpredictable and unsustainable. Philip Morris, despite legal challenges, consistently reinvested earnings to expand its operations, resulting in a remarkable 21.9% annual compounding return for shareholders over a decade. The stock market rewards businesses that increase their intrinsic value through effective use of retained earnings. Look for companies where market value growth mirrors intrinsic value, not short-term speculation. Summary: Warren Buffett's investment principles. Picture a wise fisherman named Warren. He only casts his net in waters teeming with fish, avoiding stormy seas or barren ponds. He knows which fish are worth catching and ensures his tools are simple but reliable. Warren's investment philosophy is much the same. He seeks businesses with excellent economics, low maintenance costs, smart capital reinvestment, pricing power, and a market value that grows with intrinsic value. These businesses are often consumer monopolies with strong brands, predictable profits, and conservative financing. Investing isn't about luck or chasing trends. It's about understanding the nature of the business, ensuring it retains and grows profits effectively, and holding for the long term. Focus on companies with strong fundamentals and economic advantages. They'll reel in the greatest returns. Discovering the hidden toll bridges of business, a lesson in excellence. Once upon a time, a curious entrepreneur named Alex set out to discover what made some businesses flourish while others struggled to stay afloat. Alex had heard whispers of conceptual toll bridges in the world of commerce, business models that generated consistently excellent results. But what were these mystical toll bridges, and where could they be found? With determination, Alex began to explore, learning there were 3 primary types of businesses that built such bridges. 1. Businesses with fast-depleting brand-name products that merchants must carry to stay in business. 2. Communication enterprises that provide repetitive services manufacturers need to market their goods. 3. Service providers offering repetitive, essential services to consumers and businesses. Eager to learn, Alex decided to delve into each category uncovering the secrets of their success. Tollbridge 1, the power of consumable brand name products. Alex started at the local convenience store. Standing at the entrance, Alex noticed shelves stocked with Coca-Cola, Hershey's chocolate, Marlboro cigarettes, and Doritos. These were products consumers demanded by name, so much so that merchants had to stock them to stay competitive. But what made these companies so special? Alex realized that these manufacturers enjoyed a monopoly on their brands. If a store wanted to carry Coca-Cola, it had no choice but to pay the price set by the Coca-Cola company. While merchants competed by lowering their prices to attract customers, the manufacturer earned consistent, high profits regardless. Alex thought about pharmacies and the products they must carry: Advil, Crest toothpaste, Gillette razors, and Listerine. Each was a necessity for the store, ensuring a steady stream of revenue for the manufacturer. Even in restaurants, customers ordered Coca-Cola by name, reinforcing the same toll bridge concept. These companies, Alex learned, profited not because their products were essential, but because advertising kept them in the spotlight, ensuring they remained indispensable. Tollbridge 2, the communication channels of influence. Next, Alex turned attention to the world of advertising and communication. Long ago, manufacturers relied on door-to-door salesmen, but the rise of radio, television, and newspapers changed the game. Now, manufacturers could reach millions with a single ad. Advertising agencies, television networks, and newspapers became toll bridges between manufacturers and consumers. Without advertising, a company risked losing market share to competitors. This necessity ensured consistent business for media companies. Alex discovered that a lone newspaper in a town could command premium advertising rates, knowing businesses had no alternative to reach local consumers. Warren Buffett, a legendary investor, had once invested in Capital Cities and ABC, recognizing the power of owning these toll bridges during their prime. Even today, Alex thought, advertising agencies like Interpublic continued to thrive by connecting global brands to their audiences. Tollbridge 3, essential. Repetitive consumer services. Finally, Alex explored businesses offering services rather than products. These companies operated toll bridges of a different kind, ones that addressed ongoing needs. Take ServiceMaster, for example, provided pest control, professional cleaning, and lawn care. Or Rollins, the parent company of Orkin, which handled termites and security services. These businesses thrived because their services were in constant demand, whether for battling pests, maintaining homes, or providing security. Alex also marveled at companies like H&R Block, which helped millions with their taxes every year, and credit card giants like American Express. Every swipe of a credit card generated a small fee, a toll. The genius of these businesses, Alex realized, was their efficiency. They required little investment in innovation, capital, or specialized labor. Instead, they focused on meeting consistent needs, allowing them to reinvest profits into growth and dividends. The key takeaway: Alex concluded the journey with newfound wisdom. The best businesses, those conceptual toll bridges, weren't just about selling products or services. They were about creating systems where customers had no choice but to pay the toll repeatedly. To identify such businesses, Alex learned to observe the world closely. Standing outside a supermarket or convenience store, Alex could spot the products and brands that were essential for merchants. Looking at advertising platforms or repetitive service providers revealed companies that were indispensable to manufacturers and consumers alike. These toll bridge businesses, Alex realized, weren't just about making money. They were about building enduring systems of value, earning their owners high returns for decades to come. And so Alex set out to find and invest in these gems, ready to cross the bridge to a future of success and opportunity. The moral of the story? Look for businesses that have built bridges no one can avoid crossing, and you'll find a path paved with gold. The Buffett strategy for identifying promising investment opportunities. When I first ventured into the world of Buffett-style investing, my classroom wasn't a high-rise office filled with spreadsheets and algorithms. Instead, it was the supermarket, and my lesson plan revolved around my shopping cart. Observing the products I purchased and the ones others added to their carts revealed some remarkable investment opportunities. Think about it. Coca-Cola, Philip Morris, Conagra, Kraft, Hershey's, RJR Nabisco, Kellogg's, Campbell's Soup, Wrigley's, Chewing Gum, Sara Lee, all tied to products people use daily, rain or shine. These weren't passing fads, but staples of life. From a refreshing Coca-Cola on a hot day to the timeless joy of splitting an Oreo cookie or savoring a warm bowl of oatmeal, these products form part of life's small pleasures. Generations may change, but these habits endure. My mother chewed Wrigley's gum. I chewed it as a kid. And the other day, my child handed me a piece. And that's the essence of this strategy. Some of the best investment ideas are right in front of you, often found in the aisles of your local store. These companies create products you use and understand, an essential tenet of Warren Buffett's investment philosophy. If you can't grasp what a business does or predict its future, it's better to steer clear. After all, an Oreo's market dominance is far less likely to fade than the latest tech trend. The circle of competence. Buffett emphasizes staying within your circle of competence, investing only in businesses you truly understand. He often shares the story of a friend who made a fortune investing in water companies simply because he understood their economics. Every toilet flush meant revenue. This principle is universal. Stick to what you know to minimize costly mistakes. Start with familiar brands. If you trust Kraft for mac and cheese or enjoy Coca-Cola, these are great places to begin. These are consumer monopoly businesses with strong brand recognition that act as protective moats. By contrast, commodities like gasoline, where anyone can sell the same product, offer thinner margins and less long-term security. Recognizing the difference between a consumer monopoly and a commodity is vital for assessing a company's potential. Once you've identified a promising company, the next step is research. Begin by examining the packaging to find the manufacturer and track down their corporate contact details. Reach out to request an annual report. Many companies, particularly public ones, are happy to provide it for free. Local libraries can be invaluable resources. Tools like the Guide to Business Periodicals and the Value Line Investment Survey offer insights into a company's financials, history, and market position. Take detailed notes on competitors, trends, and analyst opinions. You can also contact industry experts or competitors for additional perspectives. The scuttlebutt approach. Legendary investor Philip Fisher coined the term scuttlebutt to describe a hands-on investigative method. It involves gathering information from customers, competitors, and employees to assess a company's reputation and potential. Buffett famously embraced this approach early in his career. One notable example is his impromptu visit to Geico's offices, where a conversation with an investment officer led to one of his most successful investments. You can replicate this strategy by visiting stores, speaking with managers about product sales, and observing trends firsthand. For instance, when Marlboro reduced cigarette prices to regain market share, I confirmed the effectiveness of the move by asking convenience store clerks about sales trends, long before it made headlines. Simple, but not easy. You don't need an MBA or Wall Street experience to follow this approach. What you need is curiosity, persistence, and the willingness to dig deeper. Every product you encounter is a potential lead, but thorough research is crucial to separate worthwhile opportunities from fleeting trends. Above all, remember Buffett's golden rule. If you don't understand the business, don't invest in it. Staying within your circle of competence will protect your capital and enhance your ability to identify great companies. Investing is more than just crunching numbers. It's about understanding the stories behind the businesses and the people who run them. So the next time you sip a Coke or nibble an Oreo, ask yourself, is this just a snack or could it be an opportunity? With the right mindset, it might be both. The tale of trust and stewardship, choosing the right captains for your investment ship. Let me tell you a story about trust, stewardship, and wise decision-making in the world of investing. Imagine you've worked hard to save your money, and now you've handed it over to someone else to manage. These people, the managers of the business you've invested in, are your captains. How well they navigate the seas of business will determine whether your investment thrives or sinks. The captain's boat matters more than the captain's skills. Picture two ship captains about to race. One is seasoned, a master of the seas with decades of experience. The other is a novice, just starting to understand the ropes. But here's the catch. The experienced captain is given a tiny dinghy, while the novice gets a sleek, powerful speedboat. Who do you think will win the race? The lesson here is simple. Even the most talented captain can't overcome the limitations of a poor vessel. Similarly, in investing, no level of managerial brilliance can save a business with inherently poor economics. Conversely, a business with exceptional economics is like a speedboat. It's hard to mess up, even with a less experienced captain at the helm. Warren Buffett, one of the most successful investors of all time, often emphasizes this principle. He looks for businesses so robust that even if a fool runs them, they can still succeed. Why? Because it's the economics of the business, its ability to generate profits sustainably and efficiently, that matters most. The value of honest, owner-minded management. Now, let's talk about the human factor. Management. While the business's economics come first, management isn't something you can ignore. A hard-working, intelligent management team is critical, but only if they are honest. Without honesty, their intelligence and effort might be used to line their own pockets rather than building wealth for shareholders like you. Honest managers act like owners. They treat the company's assets as if they were their own and make decisions aimed at increasing shareholder value. One of the clearest ways to identify such managers is by observing how they allocate capital. Here are some qualities to look for. Smart capital allocation. Good managers invest in opportunities that generate the best returns. High return on equity, ROE. They ensure the company uses its equity efficiently to maximize returns. Wise use of retained earnings. When no attractive investment opportunities exist, they use retained earnings to repurchase the company's stock, increasing the value of the remaining shares. A real-life example. Capital cities. Let's illustrate this with a real example. Capital Cities Communications. Between 1989 and 1992, its management repurchased over 1 million shares of the company's stock, spending around $400 million. Why did they do this? Capital Cities operated in the broadcasting industry, a sector they understood deeply. They noticed something peculiar. Privately held broadcasting companies were being sold at very high prices. Meanwhile, in the stock market, Capital Cities' own shares were trading at a significant discount compared to those private deals. Instead of overpaying for private broadcasting companies, management chose to buy back their own stock. This decision increased the ownership stake of remaining shareholders and boosted their wealth, all without requiring those shareholders to lift a finger. Now that's smart and honest management in action. When to stay and when to leave. As an investor, you hold power. If you trust management and believe they are acting in your best interest, you stay the course. If not, you have two choices. Vote for change by electing new board members, or vote with your feet by selling your stock. The legendary Bernard Baruch once said, "The character and brains of management are most important. Poor managers can ruin even a good position." It's sage advice. After all, when you invest, you're entrusting your money to others. Make sure they are people who will steward it wisely. The takeaway. In the end, successful investing comes down to this. Choose businesses with strong economics and ensure the managers are honest, owner-minded stewards of your money. When both pieces align, you found a winner. The wisdom of Warren investing through adversity? Imagine standing in a storm, seeing chaos around you, and deciding it's the perfect time to plant seeds. That's exactly what Warren Buffett has done repeatedly in his investment journey, turning adversity into opportunity. His approach confounds many of his observers because he often buys into businesses at their bleakest moments. But there's a method to his apparent madness, rooted in principles he learned from his mentor, Benjamin Graham. The long-term view amid short-term panic. To understand Warren's strategy, let's revisit Graham's key insight. The stock market is driven by short-term thinking. Most investors focus excessively on immediate results, neglecting the broader picture. If a company has a bad year, even after decades of stellar performance, the market often overreacts, dramatically undervaluing the stock. This is where Warren sees opportunity. Where others see failure, he sees potential. Think of it this way. You own a ski resort that, over 30 years, earns an average net profit of $300,000 annually. Some years are exceptional, bringing in $600,000, while others, with poor snowfall, yield nothing. Would you sell your resort for less after a bad snow season? Of course not. You understand that the occasional dry year doesn't diminish its long-term value. The stock market, however, behaves differently. Publicly traded companies are valued year by year. A stellar year might send the stock soaring, while a bad one could crash its price. This short-sighted perspective can lead to significant undervaluation, creating opportunities for investors like Warren who think long-term. Real-life examples of opportunity in crisis. Wells Fargo banking on resilience. In the early 1990s, during a nationwide real estate recession, Wells Fargo faced turbulent times. Anticipating potential loan losses, the bank set aside $1.3 billion, or about $25 per share. Though these losses were hypothetical and part of prudent planning, Wall Street reacted as if the bank was on the brink of collapse. Over a few months, Wells Fargo's stock price dropped by over 50%. Warren, recognizing the strength of Wells Fargo's management, its key role as a money center bank, saw value where others saw risk. He bought 10% of the company at a bargain price. By 1997, Wells Fargo's stock had soared, yielding Warren a 24.6% annual return. American Express, a scandal's silver lining. In the 1960s, American Express faced a crisis when a subsidiary was embroiled in the infamous salad oil scandal. This financial disaster wiped out much of the company's equity, and Wall Street responded by driving its stock price into the ground. Warren looked beyond the scandal. He understood that American Express's core consumer monopoly, credit cards and travelers' checks, remained intact. Betting on its recovery, he invested heavily. When the market eventually recognized the company's resilience, Warren sold his stake for a substantial profit. Learning from recessions and mistakes. Recessions, while painful, often cleanse industries. Weaker competitors fail, leaving the strongest players with a larger market share when the economy recovers. Warren's investments in companies like Wells Fargo and Capital Cities highlight his ability to spot enduring value in tough times. Sometimes a company's struggles result from poor decisions rather than external forces. Geico, for example, nearly collapsed in the 1970s after insuring high-risk drivers. New leadership corrected course, and Warren saw an opportunity. His faith in Geico's core business model paid off handsomely as the company recovered. The takeaway for investors. The key lesson here is that short-term crises, whether due to recessions or one-time mistakes, often create opportunities for patient long-term investors. If a company possesses excellent management, a strong competitive advantage, or both, it can weather storms and emerge stronger. So, the next time you see a company's stock plummet due to temporary setbacks, ask yourself, is this a fleeting storm, or has the core value truly diminished? If it's the former, you might just find an investment opportunity worthy of Warren Buffett himself. The market's quirks, lessons from history. Warren Buffett, the Oracle of Omaha, often says the stock market is not always rational. Sometimes the mechanics of how stocks are traded create wild price swings that have little to do with the underlying economics of businesses. These situations, though chaotic, can be gold mines for the disciplined, long-term investor who practices what Warren calls business perspective investing. Let's dive into this phenomenon and uncover two historical examples, the panic of 1901 and the crash of 1987, the stock market's hidden traps. Think of the stock market as a giant marketplace bustling with buyers and sellers. Ideally, the price of a stock reflects all the information about a company's value, but sometimes the market goes haywire, not because of bad business news, but because of how stocks are bought and sold. This chaos stems from strategies like portfolio insurance and index arbitrage, which focus on market movements rather than business fundamentals. When these forces collide, they can spark panic, creating a domino effect of irrational behavior. Investors, driven by fear, dump stocks without considering their true worth. To the trained eye, however, such chaos can reveal opportunities. The Panic of 1901, a game of titans. In 1901, a battle erupted between E.H. Harriman and James Hill over control of the Northern Pacific Railroad. Back then, there were no regulations requiring public disclosures of large stock purchases. So, Harriman quietly bought shares, driving up the stock price. Traders, unaware of his plans, began shorting the stock, betting its price would fall. On May 6th, the stock suddenly soared. By May 9th, amidst Harriman's buying spree and panicked short sellers scrambling to cover their positions, Northern Pacific stock price skyrocketed to $1,000 per share. The chaos didn't stop there. To cover their losses, short sellers dumped other stocks, triggering a market-wide sell-off. It wasn't a recession or poor business results that caused this. It was panic fueled by market mechanics. Bernard Baruch, a savvy investor, recognized what was happening. While others sold in fear, he bought stocks of strong companies at bargain prices. As the market stabilized, Baruch reaped the rewards, marking his first major fortune. The lesson: the market doesn't always act logically. Understanding its quirks can help you spot opportunities others miss. The crash of 1987. Computers run wild. Fast forward to October 1987, and a new set of players entered the scene: portfolio insurers and program traders. These strategies relied on computers to make buy and sell decisions based on market movements, not business fundamentals. When the market dipped, these programs sold stocks to minimize losses, creating a self-reinforcing cycle of selling. By October 19th, Black Monday, the Dow Jones Industrial Average plunged 508 points, a staggering 22.6%. The chaos was exacerbated by index arbitrage, where traders exploited price differences between stock indexes and actual shares, adding more fuel to the fire. For 5 days, fear gripped Wall Street. Market makers who normally keep trades orderly ran out of cash to buy stocks. Panic spread like wildfire. Finally, regulators stepped in, halting program trading and injecting liquidity into the system. Order was restored, but not before Warren Buffett took advantage of the irrational selling to scoop up undervalued companies like Coca-Cola. The lesson: in times of market madness, focus on the fundamentals. Great companies sold in a panic are bargains for those with the courage to buy. Warren's wisdom. The stock market has a way of overreacting on the way up and on the way down. These overreactions, caused by mechanical quirks and irrational behavior, present opportunities for investors with a clear, business-focused strategy. As Warren reminds us, be fearful when others are greedy and greedy when others are fearful. By understanding the forces at play and staying rational when others panic, you can turn market chaos into long-term wealth. History doesn't just repeat, it teaches. Will you listen? Understanding Warren Buffett's investment philosophy through the lens of inflation. To truly grasp Warren Buffett's approach to investing, you need a solid understanding of what inflation is, how it comes about, and why it matters. But to understand inflation, you first need to understand money, what it is, and how it works. A brief history of money, from barter to gold. Long ago, people didn't have money as we know it. Instead, they bartered. A farmer might trade a pig for a blacksmith's plow, or a fisherman might exchange his catch for a loaf of bread. But barter had a problem. It was clunky and inefficient. Carrying sheep to market wasn't exactly convenient, and neither was trading perishable goods like milk. Over time, people discovered that certain items made better trade tools, things that were portable, durable, and universally valued. In some societies, wealth was measured in salt, cattle, or even camels. But gold and silver became the favorites. They were rare, easy to transport, and didn't spoil, making them ideal for coins. Soon, prices weren't quoted in sheep or olive oil anymore, but in pieces of gold or silver. Governments got involved, minting their own coins to pay for armies and public works. The Romans, for example, developed an extensive system of currency to unify their empire. Fast forward a few centuries, and countries like the United States introduced the dollar, initially tied to the value of gold. The birth of paper money. At some point, carrying gold coins around became as inconvenient as carrying pigs. Enter paper money, which started as certificates that could be exchanged for gold. The U.S. government, for instance, issued paper dollars backed by gold stored in Federal Reserves. People liked the convenience, and over time, the idea of redeeming these bills for gold faded from memory. Then, in 1933, something remarkable happened. The US government required all citizens to turn in their gold in exchange for paper dollars. This move, combined with other global developments, shifted the world away from the gold standard. Eventually, currencies were no longer tied to precious metals. Instead, their value came from trust and the ability of governments to manage supply and demand. World wars, printing presses, and inflation. World War I and II brought new challenges. Wars are expensive, and governments needed money fast. Printing more paper money became the solution. But when you increase the supply of money without increasing the supply of goods, something happens. Prices rise. This is inflation. Imagine an island economy where $100 million circulates and one buys a dozen eggs. If the government doubles the money supply to $200 million, people now have more dollars to spend. Merchants realize they can charge $2 for a dozen eggs. Prices rise across the board, not because goods are more valuable, but because there's more money chasing the same amount of stuff. For governments, inflation has a tempting upside. It feels like creating wealth out of thin air. But for individuals, inflation quietly erodes the purchasing power of their savings. The candy bar that cost 5 cents in 1960 now costs 50 cents. You're not getting more candy, you're just spending more money for the same thing. Warren's take on inflation. Warren Buffett sees inflation as an ever-present force, shaping economies and investments. If inflation runs at 5% annually, it means your money loses 5% of its purchasing power every year. To stay ahead, investments must earn at least as much as the inflation rate. Otherwise, your wealth shrinks in real terms. Buffett understands that governments, faced with the alternative of deflation, will almost always choose inflation. Deflation, where prices drop, sounds good at first, but it leads to lower wages, falling home values, and widespread bankruptcies. Historically, deflation has triggered economic depressions, which are political disasters. Inflation, by contrast, creates the illusion of wealth, rising wages and home prices, making it the lesser evil for politicians. Lessons for investors. Buffett's strategy accounts for inflation's impact. He looks for investments that can grow faster than the rate of inflation, preserving and ideally increasing their real value. This is why owning businesses with pricing power or assets that appreciate with inflation is critical. Lastly, a word of caution. Gold is now legal for Americans to own again, but if history repeats itself, the government might one day ask you to trade it for paper dollars. As the saying goes, fool me once, shame on you. Fool me twice, shame on me. The lesson of inflation, a tale of two businesses. For years, Warren Buffett believed inflation was the nemesis of any investor, and for most people, he was right. Inflation erodes the value of money, making promises to pay in the future fraught with risk. Imagine an economy riddled with inflation. Homeowners and corporations might seem to win, but the real losers are often the investors. Take homeowners in the 1960s, for example. They locked in 30-year mortgages at just 5%, a decision that looked genius as inflation caused their incomes to rise while their fixed mortgage payments stayed the same. Corporations benefited too, borrowing money at fixed rates and repaying with inflated dollars. But investors, not so much. A $4,000 bond that could have bought a brand new car in the 1960s might only buy a quarter of a car by the 1990s. Inflation silently taxed their purchasing power. Yet in 1983, Warren uncovered an important truth. Not all investments suffer from inflation. Some businesses, particularly those with strong consumer monopolies and minimal capital needs, could actually thrive. The sweet example of See's Candy. To illustrate, Warren turned to See's Candy, a company Berkshire Hathaway bought in 1972. Back then, See's earned $2 million annually on $8 million of net tangible assets, a 25% return. For Berkshire's $25 million purchase price, this translated to an 8% after-tax return. Compared to government bonds yielding a pre-tax 5.8% return, See's looked pretty sweet. Now contrast See's with a steel manufacturer earning the same $2 million. Unlike See's, the steel company needed a hefty $18 million of net tangible assets to achieve this. Enter inflation. Let's fast forward a decade, imagining a world where inflation doubles prices. Both Sears and the steel manufacturer double their earnings to $4 million, thanks to higher sales prices. But here's the catch. Assets wear out and must eventually be replaced at inflated costs. Sears, with its $8 million asset base, now needs $16 million to replace its equipment. The steel manufacturer, however, requires $36 million. That's an additional $20 million just to stay operational. The investor's choice: which business would you rather own? The answer is clear: Sears. Its smaller asset base means lower replacement costs, freeing up more of its earnings to benefit shareholders. This is where inflation, typically the villain, becomes an ally to businesses with minimal capital needs and strong pricing power. Companies like Sears can maintain high returns on their modest asset bases, while capital-intensive businesses like steel manufacturing struggle under the weight of inflation-driven costs. The takeaway: inflation doesn't treat all investments equally. It erodes the purchasing power of bonds and hurts capital-intensive industries. But for companies with strong consumer monopolies and low capital requirements, like See's Candy, it's a hidden advantage. In the stock market, this advantage doesn't go unnoticed. Businesses with these traits often enjoy higher price-to-earnings ratios, reflecting their ability to turn inflation into a win for investors. So, as Warren Buffett learned, inflation isn't always the enemy. It just depends on where you place your bets. The story of taxes and investments. Taxes! A word that makes most people sigh, groan, or feel a twinge of anxiety. But for investors, taxes are more than just a line item on a paycheck. They're an integral part of the investing journey, a thread woven into the fabric of decision-making. So let's pull back the curtain on taxes and their role in investing. And don't worry, I promise to keep it concise, clear, and, dare I say, engaging. The tax landscape. Imagine you're a shareholder of a company called Bright Futures Inc. This company just had a fantastic year and earned $10 per share in profit. That's great news, right? But hold on. Before you can claim that $10, taxes enter the scene. When Bright Futures earns its $10 per share, it pays corporate income taxes first. The remaining amount, what we call net income, is already after-tax money. If Bright Futures reports earnings of $10 a share, that's the after-tax figure. Now the company faces a decision: what to do with those earnings. 1. Pay dividends. It could reward its shareholders by paying out dividends. If you own one share and they pay a $10 dividend, you'll have to report that $10 as income and pay taxes on it. Let's say you're in the 31% tax bracket. You'd fork over 310 cents in taxes, leaving you with 6/9. 2. Retain earnings. Alternatively, Bright Futures could retain the $10, reinvesting it into the company's growth. In this case, as a shareholder, you pay no taxes yet. The earnings stay within the company, potentially growing its value. 3. A mix of both. The company might split the difference, paying $7 as a dividend and retaining $3 for growth. The personal versus corporate tax game. Here's a twist. Corporations and individuals play by different tax rules. If Bright Futures pays dividends to another corporation, the recipient pays a tax rate of around 14%. But for you, as an individual, dividend income is taxed as regular income, potentially as high as 39.6%, depending on where you live and your income bracket. That's a significant difference. Capital gains taxes add another layer to the puzzle. If you sell your shares in Bright Futures for a profit, you'll pay a capital gains tax. For individuals, that's usually capped at 20%, but corporate investors might face higher rates. Why it matters. Warren Buffett, the master of long-term investing, is highly attuned to the impact of taxes. For him, taxes aren't an afterthought, but a critical factor in deciding which investments to make and how long to hold them. If a company retains its earnings, it defers taxes for its shareholders, allowing compounding to work its magic. On the other hand, frequent trading or high dividend payouts could trigger significant tax obligations, chipping away at overall returns. The big picture. The rules and rates governing taxes fluctuate with the winds of political change, but the principle remains the same. Taxes are a constant companion in the investing journey. They shape the path we take, the vehicles we choose, and the timing of our moves. So as we dive deeper into the investment world, remember, Taxes aren't just a cost. They're a factor to manage, a puzzle to solve, and when approached wisely, an opportunity to maximize your wealth over the long haul. The tale of inflation, taxation, and the investor's dilemma. Once upon a time in the bustling world of finance, there lived an investor named Warren, who had a sharp eye for numbers and a deep understanding of how the economy shaped wealth. Warren often shared his insights with those who would listen, offering wisdom about the hidden forces that could quietly erode an investor's gains. Two such forces, inflation and taxation, played a critical role in the story of wealth. Inflation, the silent erosion. Warren explained it like this. Imagine you own a golden apple worth $100. In a world with 5% inflation, the cost of everything rises by 5% each year. If you do nothing with your golden apple, its value remains $100, but the cost of goods and services increases. After a year, you'll need $105 to buy the same basket of goods that once cost $100. Effectively, your golden apple has lost its purchasing power. That's why we invest, Warren said. If we don't, our wealth held in cash will shrink in real terms, even if it looks the same on paper. To simply break even in a world of 5% inflation, an investor must earn a return of at least 5%. But that's just the starting point. If your return matches inflation, your purchasing power doesn't grow. It merely stays the same. A real increase in wealth requires a return greater than the rate of inflation. For instance, in a world with 10% inflation, an investor needs a return greater than 10% to see any real growth. Taxation, the other side of the equation. But inflation wasn't the only challenge. Taxation, Warren explained, was like a toll collector on the road to wealth. Imagine earning a 5% return on your investment. If you're in an income tax bracket of 31%, nearly a third of that return is claimed by the government. After taxes, your effective return is only 3.45%. Now consider inflation again. If inflation is running at 5%, your real return, the gain in purchasing power, is negative 1.55%. Not good at all, Warren would say with a knowing nod. To avoid losing purchasing power in a world with 5% inflation and a 31% tax rate, you'd need to earn a pre-tax return of 7.2%. Only then would you break even. To grow your wealth, you'd need an even higher return. The compounding challenge. Warren often pointed to an example from history. The 1970s, when inflation reached 9% and personal income tax rates climbed to 40%. In such a scenario, an investor needed a pre-tax return of at least 15% to preserve their wealth. Here's how it worked. 1. A 15% return minus 40% in taxes leaves 9%. 2. Subtracting 9% inflation from the post-tax return leaves 0%, just enough to maintain purchasing power. Warren set a goal for himself. He wanted a minimum pre-tax return of 15% per year to ensure he stayed ahead of inflation and taxation. The wisdom of Graham Warren, often referred to his mentor, Benjamin Graham, who once observed that the long-term economic trend tends toward inflation, though it may be punctuated by periods of deflation. Graham believed that while stocks weren't a perfect hedge against inflation, they offered better protection than bonds or cash. The moral of the story. Warren's teachings left his listeners with a clear lesson. To achieve real growth in wealth, an investor's returns must outpace both inflation and taxation. If inflation eats away at your purchasing power and taxes claim a portion of your returns, standing still is not an option. Your investments must work harder, earning returns that account for these eroding forces. Only then can your wealth grow in both nominal and real terms, safeguarding your future. And so, Warren's tale serves as a reminder to all investors. To truly prosper, always keep an eye on the silent tolls of inflation and taxation. From diversification to conviction, Warren's journey to focused investing. Once upon a time, there was an investor named Warren who believed that diversification was, at its core, a defensive strategy, a safeguard for those who lacked deep understanding or confidence in their ability to pick great businesses. Diversification, Warren mused, is what people do when they're not sure of what they're doing. He observed that many investors spread their wealth thinly across numerous stocks, hoping to protect themselves from their own ignorance. Warren's mentor, Benjamin Graham, had championed a different approach. Graham advocated owning a vast portfolio, sometimes 100 or more stocks. To him, this wide net served as insurance against the inevitable duds, businesses that failed to thrive either as companies or as investments. Graham's method emphasized the numbers, valuations, earnings, and balance sheets over intimate knowledge of the businesses. He wasn't particularly concerned with understanding the companies themselves in great detail. He trusted the math to guide him. Warren, ever the diligent student, started his investment journey following Graham's philosophy. But over time, he found that managing such a sprawling portfolio felt more like running a zoo than stewarding investments. There were too many animals to watch, too many moving parts. He realized that his true passion and his greatest skill lay in truly understanding the businesses he invested in, not simply collecting a scattershot portfolio. Enter the ideas of Philip Fisher and Charlie Munger, who would profoundly influence Warren's evolution. Fisher agreed that diversification could mitigate risks, but believed it was often taken to absurd extremes. Investors, Fisher warned, end up with so many stocks that they have no real understanding of any of them. Trying to monitor dozens of companies often resulted in broken eggs, so to speak, as the investor lost sight of what they owned and why. Fisher's approach championed a focused portfolio of businesses that the investor deeply understood, because in his view, it was impossible to keep an eye on all the eggs in countless baskets. Then there was the wisdom of John Maynard Keynes, the brilliant British economist who had said that most of his wealth came from just a handful of investments. His secret? He only placed his money in businesses he truly understood. Warren, deeply inspired by Keynes, adopted this concentrated portfolio approach himself. Instead of owning dozens or hundreds of stocks, he focused on a small number of exceptional businesses. By investing significant amounts in just a few well-understood companies, Warren was able to take each decision seriously, pouring time, energy, and analysis into each one. This rigorous process reduced risk, not through diversification, but through knowledge and conviction. Warren would often say, if you were only allowed to make 10 investment decisions in your entire life, you'd think long and hard before each one. The idea resonated because it underscored the importance of patience and diligence. Many investors, Warren observed, would never dream of investing in a local business without asking hundreds of questions. Yet when it came to stocks, they handed over their money after a single phone call from a broker. To Warren, this behavior was baffling and reckless. He also drew inspiration from another sage, Bernard Baruch, who once said, "Time and energy are required to keep abreast of the forces that may change the value of a security. While one can know all there is to know about a few issues, one cannot possibly know all one needs to know about a great many." Baruch's long and prosperous life stood as a testament to the power of focus and discipline in investing. In the end, Warren found his true north in concentrated investing. By owning only a handful of great businesses, companies he truly understood and valued at prices that made sense, he minimized his chances of loss and maximized his potential for long-term success. It was a strategy built on careful thought, rigorous analysis, and unwavering conviction. And so Warren's story teaches us this. Investing isn't a game of numbers. It's a game of understanding. Whether it's 10 stocks or 10 decisions, success comes from knowing what you own, why you own it, and the discipline to hold on for the long haul. The art, science, and folklore of selling investments. Investing is often described as 50% science, 50% art, and intriguingly, 100% folklore. That last bit may sound puzzling, but as we dive into the world of selling investments, you'll see how much of it is shaped by stories, maxims, and traditions passed down through the years. One of the most quoted sayings in Wall Street folklore is, "No one ever went broke by selling at a profit." True, perhaps, but Warren Buffett, the legendary investor, might counter. No one ever got really wealthy that way either. That should spark a question in your mind. If selling at a profit isn't the golden rule for building extraordinary wealth, what is? Let's unravel the wisdom behind this mystery, learning from both Benjamin Graham and Warren Buffett's contrasting approaches to selling investments. Graham's method, a practical approach. Benjamin Graham. known as the father of value investing, believed that the secret to successful investing lay in buying securities below their intrinsic value and selling them once they reached that value. His logic was simple. Once a stock is fully valued, it has no further profit potential. It's better to take your profits and reinvest in another undervalued opportunity. Graham had a meticulous method. Suppose he bought a stock for $15, estimating its intrinsic value at $30 to $40. Once the price hit $30, he would sell and move on. Why? Because the longer it takes for a stock to reach its intrinsic value, the lower the annual compounding rate of return. For example, if a $20 stock rises to $30 in 1 year, your return is 50%. If it takes 2 years, the annualized return drops to 22.4%. In 3 years, it's 14.4%, and so on. The math is clear. Time erodes returns. To mitigate this risk, Graham advocated for a margin of safety when buying undervalued stocks. The greater the uncertainty about how long it will take to realize the intrinsic value, the larger the margin of safety required. But Graham knew not every stock would reach its intrinsic value. He advised waiting 2 to 3 years before selling a stock that hadn't appreciated as expected, reasoning that beyond this point, the market might never recognize the stock's true worth. Warren Buffett's evolution: never let go of great businesses. While Graham's strategy was effective, Warren Buffett found it lacking. Too often, he ended up holding dogs that never appreciated or selling stocks too early, incurring taxes and missing out on long-term gains. Enter Charlie Munger and Philip Fisher, two influential thinkers who helped shape Warren's investment philosophy. They argued that instead of flipping undervalued stocks, one should invest in excellent businesses, companies with strong growth, enduring competitive advantages, and shareholder-friendly management, and hold them indefinitely. Their logic was compelling. 1. Great businesses generate high returns on equity. 2. These businesses reinvest their profits, creating a compounding effect. 3. Over time, this compounding leads to massive growth in the company's value. Warren shifted his focus to buying outstanding businesses at fair prices and holding them as long as their fundamentals remained strong. This strategy led to some of his most legendary investments, including the Washington Post and Geico, both of which have delivered annual returns exceeding 17% for decades. As Warren likes to say, you don't pull out the flowers and water the weeds. Selling a flourishing investment simply because it's profitable misses the bigger opportunity, the power of long-term compounding. Selling in bear and bull markets. Market cycles, bear and bull markets, often tempt investors to sell out of fear or greed. Brokers may encourage clients to take a defensive position, moving into cash to prepare for a potential downturn. But this approach comes with hidden costs. Taxes and fees. Selling triggers capital gains taxes and brokerage fees, reducing the capital available for reinvestment. Timing risk. Investors rarely re-enter the market at the right time. Fear often leads to hesitation, causing missed opportunities. Philip Fisher once observed that trying to time the market rarely works, and Bernard Baruch famously quipped, "Don't try to buy at the bottom and sell at the top. This can't be done, except by liars." Buffett avoids this trap by focusing on the business, not the market. If the business fundamentals are sound and the price is right, he invests, whether it's a bear or bull market. During the 1987 market crash, when others were panic selling, Buffett seized the moment to buy Coca-Cola stock at a bargain price, investing $1 billion. His confidence stemmed from his business-oriented approach. He knew the market's fear created opportunity. The key to Warren's success. Buffett's long-term strategy hinges on identifying businesses with 1. A durable competitive advantage, e.g. a consumer monopoly. 2. Consistent per-share earnings growth. 3. Shareholder-friendly management. These attributes ensure continuous growth in intrinsic value, leading to higher stock prices over time. Instead of chasing short-term profits, Buffett lets compounding work its magic, achieving extraordinary returns over decades. The takeaway. Warren Buffett's philosophy on selling is a lesson in patience, discipline, and perspective. While selling at a profit may feel like a win, the real wealth lies in holding great businesses long enough to benefit from their compounding growth. The next time you're tempted to sell a thriving investment, remember Warren's wisdom. Outrageous profits come from extraordinary patience. Don't let the allure of a quick gain rob you of the long-term wealth that only time can deliver. Warren Buffett's Masterclass, Investing with Perspective. In the realm of investing, few names command as much respect and fascination as Warren Buffett's. Through a lifetime of disciplined investing, he has built an empire by understanding businesses, assessing their value, and deploying capital in ways that maximize returns. However, while his primary focus is often on acquiring entire businesses or taking long-term positions in exceptional companies, there's much more to his strategy that the public often misunderstands. Let's delve into the breadth of his investment approach, focusing on how he navigates various types of securities while always anchoring his decisions in sound business economics. The core of Buffett's philosophy. Imagine you own a small shop that generates a steady profit every year. If someone offered to buy your shop outright for a fair price, you might sell it, especially if you trusted they would preserve its legacy. This is Buffett's ideal scenario, purchasing 100% ownership in businesses with excellent economics and management. But life doesn't always serve up the perfect deal. When buying an entire business isn't feasible, Buffett opts for his second-best strategy, making long-term investments in the common stock of companies with outstanding qualities. Yet even beyond these two preferences, Buffett finds profitable ways to deploy capital. The other avenues of investment. Buffett's portfolio isn't exclusively about blockbuster stock picks or outright acquisitions. He also invests in long-term fixed income securities, medium-term fixed income securities, short-term cash equivalents, short-term arbitrage commitments. These alternative investments aren't his favorites, nor do they offer the extraordinary returns he achieves from businesses like Coca-Cola. However, they serve an important purpose, generating profits while he waits for more favorable opportunities. Long-term fixed income securities. Rare gems. Buffett typically avoids long-term bonds because they often deliver mediocre returns and are vulnerable to inflation, which erodes their value over time. Yet in rare cases, he makes exceptions. Take his investment in Washington Public Power Supply System (WPPSS) bonds in the early 1980s. The WPPSS had defaulted on billions in debt for 2 projects, creating a unique opportunity. Buffett assessed the situation as if he were evaluating a business. The investment. Buffett spent $139 million on WPPSS bonds, which paid a tax-free annual interest of $22.7 million, a 16% after-tax return. The rationale? Buying a business that earned $22.7 million after taxes would typically cost $250 to $300 million. By purchasing the bonds instead, Buffett achieved a similar outcome for roughly half the cost. The perspective. To Buffett, bonds can be treated as a business, providing predictable income and a capped upside. In this case, the business of the WPPSS bonds offered compelling economics. Medium-term fixed income securities, a practical alternative. Medium-term bonds, 8 to 12 years, are another tool in Buffett's arsenal, albeit a reluctant one. In 1986, for instance, he invested $700 million in tax-exempt bonds, not because they were stellar opportunities, but because they were the best alternative to holding cash. Convertible preferred stocks. Buffett extended this medium-term strategy to investments like Salomon Brothers' 9% preferred stock. These securities offered modest returns, but came with unique tax advantages for Berkshire Hathaway. Why did he choose such investments? Because they provided a safe harbor for his funds while he waited for exceptional opportunities, like buying Coca-Cola stock, to materialize. Short-term cash equivalents. The part. Imagine parking your car while you scout for the perfect destination. Buffett treats short-term cash equivalents, such as treasury bills or municipal notes, like parking spots for his capital. These investments are low risk and ensure liquidity. They don't make headlines, but they're better than letting cash sit idle. Short-term arbitrage. A special tool! Short-term arbitrage is Buffett's secret weapon for capitalizing on unique opportunities. When structured properly, these commitments can yield profits in a matter of months. However, the details are complex enough to warrant an entire chapter in Advanced Buffett's strategy. The wisdom behind Buffett's approach. Each of Buffett's investment choices, whether long-term or short-term, shares a common thread: the principles of business perspective investing. He evaluates bonds, preferred stocks, and arbitrage opportunities as if they were entire businesses, weighing their potential returns against alternative uses of his capital. The lesson? Don't let the complexity of investing deter you. By thinking like a business owner, you can simplify your decisions, focusing on what matters most: understanding value, managing risk, and seizing opportunities when they arise. Now that we've explored the breadth of Buffett's strategies, it's time to take a deeper dive into the specifics of valuation and pricing. Turn the page, and let's unravel the art of paying the right price for the right investment. Mastering the numbers, navigating the quantitative world of Advanced Buffett's strategy. You've journeyed through the qualitative landscape of this book, uncovering the principles, philosophies, and foundational knowledge that define the essence of intelligent investing. Now, standing before you is the next leg of the journey, the quantitative portion. This is where math becomes your compass, guiding you to assess whether a stock's market price aligns with sound business logic. This segment is not just important, it's essential. Here, you'll acquire the mathematical skills necessary to apply a business-focused investment strategy, a strategy rooted in the timeless principles of Buffett's strategy. While the equations may seem intimidating at first glance, we've taken great care to ensure they're accessible and practical. With the financial calculator we recommended earlier, these calculations will feel less like hurdles and more like stepping stones. The structure of this part is designed to build your confidence and understanding step by step. It begins with a set of small but crucial chapters that introduce mathematical tests. These tests will become your tools for determining the price at which a potential investment makes business sense. But before diving into the numbers, you'll explore a chapter on the analyst's role in evaluating earning power, a cornerstone of intelligent investing. Next comes a series of case studies. These stories will show you how to apply what you've learned in real-world scenarios, turning theory into practice. Following this, you'll step into the shoes of a young Warren Buffett, exploring the chapter titled How Warren Got Started, the Investment Vehicle. This chapter provides a roadmap for starting your own investment partnership, just as Warren did. And then, as a finale, you'll find two invaluable resources. The first is a curated list of 54 companies, each a gem that Warren has invested in before and that your authors believe still align with his investment philosophy. The second is a chapter titled Waiting for the Perfect Pitch, a reflection on patience and precision in the art of investing. So, are you ready to master the numbers and take your understanding to the next level? With a clear mind, your calculator in hand, and a sense of curiosity, let's embark on this exciting part of the journey. Let's begin. The Art of Long-Term Investment, a lesson from Warren and Graham. Once upon a time, in the bustling world of finance, there lived two remarkable minds, Benjamin Graham, the father of value investing, and his protege Warren Buffett. These two titans of investing approached the stock market not as a roulette wheel, but as a place to make thoughtful, informed decisions based on deep analysis. Warren, inspired by Graham's teachings, developed a unique way of evaluating businesses. For Warren, understanding a company wasn't just about its current price or this year's earnings. It was about peering into the future to predict the long earning power of the business. By doing so, Warren could estimate the annual compounding rate of return he might achieve by investing in the company. This approach required precision, discipline, and a willingness to look far beyond the horizon. The Wall Street analysts, by contrast, typically focused on the short term. They would predict earnings for the next quarter or, at most, the coming year. Why? Because they believed that even short-term predictions were fraught with enough uncertainty. The idea of looking 5, 10, or even 20 years ahead seemed nearly impossible. Graham, however, challenged this mindset. In his classic work, Security Analysis, he criticized this narrow focus, arguing that it was not enough to base an investment decision on the earnings of just 1 or 2 years. He believed that true value could only be determined by understanding the long-term earning power of a business. He stated the analyst could do a more dependable or professional job of passing judgment on a common stock if he were able to determine some objective value, independent of the market quotation, with which he could compare the current price. This principle became the foundation of Warren's investment philosophy. Warren's advancement in security analysis. Warren took Graham's teachings to heart but went further. He developed criteria for identifying businesses whose long-term earning power could be accurately predicted. While most analysts were content with short-term forecasts, Warren sought out companies with stable, predictable, and growing earnings over decades. These were often businesses with strong competitive advantages, what Warren calls economic moats. By mastering this skill, Warren could see opportunities others missed. He wasn't swayed by the daily fluctuations of stock prices or the quarterly earnings reports that kept Wall Street analysts busy. Instead, he focused on the big picture, the long-term economic reality of the business. Your role as an investor. Now, imagine yourself as an investor walking in the footsteps of Graham and Warren. Your mission is clear. 1. Identify businesses with long-term earning power. Look for companies with strong competitive advantages, predictable earnings, and a track record of stability. 2. Estimate the prospective return. Use mathematical valuation techniques to understand the earning potential of the business. Consider how its earnings and dividends might grow over time. 3. Make informed investment decisions. Compare the intrinsic value of the business to its market price. If the price offers a favorable return, based on your long-term predictions, seize the opportunity. The tools of the trade. To accomplish this, you'll need to master a few key mathematical techniques. These equations will help you estimate the future earnings and dividends of a business, determine the compounding rate of return, assess the intrinsic value of a stock. By doing so, you'll gain a deeper understanding of the economic realities of the businesses you analyze. The lesson of patience and precision. As Graham and Warren have shown, investing is not a game of chance, it's a discipline. The greatest rewards come not from following the crowd or reacting to short-term market movements, but from taking the time to understand the long-term potential of a business. With patience and precision, you can uncover the hidden gems that will grow your wealth over time. So, take up the challenge, learn the techniques, refine your judgment, and always think long-term. In doing so, you'll follow in the footsteps of 2 of the greatest investors the world has ever known. Unlocking Investment Success, the detective's guide to evaluating companies and their true value. Imagine you're an aspiring investor, standing at the edge of a vast marketplace. In your hands is a simple toolkit, your mathematical tools. They aren't flashy or complex, but they hold the power to help you decide whether a potential investment makes business sense at the price being offered. Before you even reach for your calculator, though, there are critical steps to take. Picture yourself stepping into the shoes of a detective. Your first task is to uncover the nature of the company you're considering. Is this business a titan with a consumer monopoly? Something so beloved and essential that customers return again and again? Or is it a commodity business, one caught in the endless grind of competition, destined for only average results? Once you've identified the type of business, shift your focus to the people steering the ship. Are the managers honest? Competent? Do they act with the shareholders' best interests at heart? Even Warren Buffett, the legendary investor, has observed that poor management can sometimes hinder the profitability of even the greatest consumer monopolies. Take Coca-Cola in the 1970s as an example. At the time, Coca-Cola had an extraordinary consumer monopoly, practically a goldmine of customer loyalty. Yet, its management seemed unsure how to maximize the per-share value of the company. It was like having a race car but not knowing how to shift gears. The business stagnated, its potential unrealized. But then, in 1980, Roberto Goizueta took the wheel. He understood Coca-Cola's strengths and capitalized on them, driving the company's earnings higher and its stock price to soar like a rocket. As an investor, you must also evaluate whether the management knows how to wisely allocate capital. Can they turn company profits into even greater returns? Here's where your toolkit of calculations comes into play. After determining the business's economic nature, these mathematical tools will guide you in deciding if the stock is selling at an attractive price. Remember, investing isn't just about numbers. It's about understanding the story of the company, the vision of its leaders, and the value it offers. With these insights and your trusty toolkit, you'll be better equipped to make decisions that can lead to lasting success. The story of predictable earnings, a simple lesson in investment analysis. Imagine you are stepping into the world of stock analysis for the first time. It's like being handed a treasure map, but you're unsure where the treasure lies. The first clue, however, is simple: the earnings history of a company. When you pick up an investment survey service like Moody's or Value Line, the very first thing your eyes should scan is the per-share earnings over the past several years. This is the simplest test you can perform, yet it holds immense power. Though it seems basic, comparing yearly earnings is the first critical step in statistical analysis. Let's explore this through the earnings of two fictional companies, Company 1 and Company 2. Company 1 shows steady growth, with per-share earnings increasing almost every year, barring a small drop in 1988. The trend is clear and comforting to any investor. Upward momentum. Company 2, in contrast, is wildly inconsistent. Its earnings jump up and down unpredictably, showing no discernible trend. Losses in some years and sporadic gains in others make it difficult to predict the future. Which company would you bet on? Without any advanced calculations, it's obvious. Company 1 is the safer choice. Its steady earnings growth suggests a solid foundation and predictable future. This is the kind of stability that most investors, including Warren Buffett, would find attractive. Buffett often seeks companies with consistent earnings because they provide a sense of security. If a company's earnings history is strong and trends upward, it suggests that the business model is robust and sustainable. On the other hand, Company 2, with its erratic earnings, offers no such comfort. While it still has potential for investment under specific conditions, the Benjamin Graham's approach, its unpredictability makes it less appealing to Buffett-style investors. A real-life application: Coca-Cola. Let's move from fictional companies to a real example: Warren Buffett's purchase of Coca-Cola stock. In 1994, Buffett bought 257,640 shares at $21.95 per share. Why? Because when he looked at Coca-Cola's earnings from 1983 to 1994, he saw a consistent and steady upward trend. The upward trajectory was clear. Coca-Cola had proven its ability to grow earnings consistently over more than a decade. This kind of predictability gave Buffett the confidence to invest heavily. The lesson: when you first look at a company, don't get lost in complex metrics. Start simple. Examine its earnings history over the past 7 to 10 years. Are the numbers stable? Do they trend upward, or do they swing wildly? If the earnings are consistent and growing steadily, the company likely has a solid foundation. If the earnings are erratic, the company might still have potential, but predicting its future will be much harder. The easiest and most powerful insights often come from the simplest observations. Start here, and you'll already be ahead in your investment journey. Understanding investment returns, a story of lemonade stands and Coca-Cola. Imagine you're standing in front of a small lemonade stand in 1979. It's a modest business, but the numbers are impressive. The lemonade stand, let's call it Capital City's Lemonade, is offering shares for $3.80 each. You've heard the stand made $4.06 per share in profits last year. You pull out a small notebook and do a quick calculation. If you invest $3.80, you'll be earning 46 cents for every share you buy. To figure out your initial rate of return, you divide the earnings by the price, 0.46 by 3.80, 0.121, or 12.1%. So your initial rate of return on this investment would be 12.1%. Pretty good, right? Fast forward to 1988, and now we're looking at a larger and more famous business, Coca-Cola. Warren Buffett, the famous investor, decides to buy shares at $5.22 each. Coca-Cola's profits per share that year were 36 cents. Using the same calculation, 0.36 for 5.22 equals 0.0689 or 6.89%. This means Warren's initial rate of return on his Coca-Cola investment was 6.89%. But wait, fast forward to 1994. Coca-Cola's share price has risen to $21.95 and earnings have grown to 98 per share. Again, the same calculation shows 0.98 but 21.95 equals 0.045 or 4.5%. The initial rate of return has dropped because the share price is much higher. At this point, Warren doesn't stop at the initial rate of return. He couples it with Coca-Cola's estimated earnings growth, around 17% to 19% annually. Essentially, he views Coca-Cola stock as a kind of equity/bond. It starts with a 4.5% return, but that return grows as Coca-Cola's profits grow over time. Here's the key takeaway Warren and his mentor Benjamin Graham emphasize. The price you pay determines your rate of return. If you pay a lower price for a business relative to its earnings, your rate of return will be higher. If you pay a higher price, your return starts lower. This principle forms the foundation of value investing, buying great businesses at reasonable prices to maximize your returns. So, whether you're buying lemonade stands or shares of Coca-Cola, remember this golden rule. The better the deal you get, the better your returns will be. The story of growing shareholder value. Once upon a time, there was a company, thriving with the potential to create wealth for its shareholders. The key to this success lay in management's ability to grow the company's earnings per share, EPS. This metric wasn't just a number. It was a measure of how effectively the company used its profits to generate value for its owners. To grow EPS, management had to deploy retained earnings wisely, those portions of profits reinvested into the company instead of being distributed as dividends. Whether through expanding operations, improving efficiency, or venturing into profitable new areas, these investments had to generate returns that exceeded their costs. Over time, consistent growth in EPS would naturally lead to higher valuations for the company's stock in the market. The magic of compounding growth. To evaluate a company's ability to grow its EPS, a simple but powerful tool is at our disposal, calculating the annual compounded growth rate of EPS. This provides insights into the company's performance over both the long and short term. Let's meet General Foods, a company from 1970 to 1980. Year per share earnings. 1970, $2.03, 1980, 5s and 4. How do we calculate its 10-year compounded growth rate? Think of the 1970 earnings of $2.38 as the present value PV and the 1980 earnings of $5.14 as the future value FV. The number of years N is 10. Using a financial calculator, input these values and compute the annual growth rate, cent-I. Voila! The result is 8% per year. Now let's zoom in on a shorter period, 1975 to 1980. Year per share earnings, 1975, 3, 1980, $5.01 earned. Here, 302 is the PV, $5.43 is the FV, and N is 5. The calculation gives an annual growth rate of 11.2% for this period. These numbers tell an interesting story. General Foods achieved faster EPS growth in the latter 5 years. The natural next step is to ask, why? Did the company find new profitable ventures, or did it buy back shares to reduce the number of outstanding ones? Understanding these factors is essential for predicting future growth. Applying the test to Coca-Cola. Fast forward to 1994, and let's analyze Coca-Cola, a company that caught Warren Buffett's eye. Between 1984 and 1994, Coca-Cola's per-share earnings grew at an impressive 17.2% per year. From 1989 to 1994, the growth rate was even higher, 18.4% per year. Year per-share earnings, 1984, 1994, 1994, 90 estimated. To compute the 10-year growth rate, treat 20 cents as the PV and 98 as the FV. With n set to 10, the calculation yields to 17.2% for the shorter 5-year period, a 19-year period at 19, and use 42 cents as the PV and 98 as the FV with n as 5. The result is 18.4%. Dashed! The decision-making lens. In 1990, Coca-Cola's stock price was $21.95, and its estimated EPS was 98. This case get an initial after-tax return of 4.5%, 98 plus 21.95. But the real magic lay in the compounding growth. With EPS growing at 17.2% to 18.4% annually, Warren Buffett recognized that Coca-Cola wasn't just a beverage company, it was a compounding machine. The takeaway. By understanding a company's EPS growth over time, you gain a window into its management's ability to create value. The story of General Foods and Coca-Cola shows how a simple calculation can reveal powerful insights, guiding investors toward decisions that compound their wealth year after year. And so, the lesson is clear. When you find a company that grows its EPS consistently and invests its retained earnings wisely, you've discovered a treasure trove for long-term growth. The value of a company relative to government bonds, a lesson from Warren Buffett's investment in capital cities. Once upon a time in 1979, Warren Buffett analyzed an investment opportunity that provides an excellent lesson in evaluating a company's value relative to government bonds. The company in question was Capital Cities, a media business that would later become part of a famous Buffett success story. Let's unpack how this method works and why it mattered in his decision-making process. Step 1. Understanding relative value. Imagine you're considering two investments, government bonds and a company's stock. To compare them, you can calculate the company's relative value by dividing its current per-share earnings by the current rate of return on government bonds. This calculation gives you a quick benchmark for comparison. In the case of Capital Cities, per-share earnings in 1970 47 cents, rate of return on government bonds 10% or 0.10. Using the formula, text, relative value equal frac, government bond rate of return. Text relative value equals frac 0.47 and equals 4.7. This means that if you paid $4.7 per share for Capital Cities stock, your return would equal the 10% offered by government bonds. Step 2. Comparing market price to relative value. Now let's look at the stock price. In 1979, Capital Cities stock traded between $3.60 and $4.70 per share. At the lower end of this range, $3.60, you could buy the stock at a price below its relative value. What does this mean? If you purchased the stock at $3.60 per share, your return would exceed 10%, since you're buying at a discount to its relative value. Step 3. Factoring in earnings growth. But there's more to the story. Capital Cities wasn't just any company. It had an impressive annual per-share earnings growth rate of approximately 21% from 1970 to 1979. This meant that its earnings were not static but growing at a significant rate. So now, imagine you're faced with a choice. Option A, $4.70 worth of a government bond offering a static 10% return. Option B, a Capital Cities equity bond that matches or exceeds a 10% return, with the added bonus of earnings growing annually at 21%. Which would you choose? Most investors would lean toward option B, as the prospect of compounding earnings growth makes it far more attractive. Step 4. Intrinsic value versus relative value. It's important to clarify a common misunderstanding. When you divide per-share earnings by the government bond rate, you're not finding the company's intrinsic value. What you're determining is its value relative to government bonds. Similarly, when analysts use the method of discounting future earnings to present value, the result is often relative to the discount rate chosen, in many cases, the government bond rate. These methods are helpful but must be used thoughtfully. Step 5. Accounting for taxes. One final note of caution. Government bond returns are pre-tax, while a corporation's per-share earnings are after tax. Ignoring this distinction can lead to misleading comparisons. The takeaway. Warren Buffett's decision to invest in capital cities demonstrates the power of comparing company earnings to government bond returns. By combining this relative value calculation with an analysis of earnings growth and market price, he identified an investment opportunity that outshined the static returns of bonds. For you, this method serves as one more tool in the investor's toolkit, useful for understanding value, but not a definitive measure of a company's worth. Always consider growth potential, market conditions, and the tax implications when making your investment decisions. The Tale of Two Businesses. Learning the wisdom of Warren. Once upon a time, there were two small but thriving companies in a bustling town. Company A and Company B. They both had similar beginnings, $10 million in total assets and $4 million in liabilities. This left them each with $6 million in shareholders' equity, a measure of the owner's stake in the business. Despite their similarities on paper, there was one key difference: how well they utilized their equity to generate profits. Company A, under the guidance of a sharp and resourceful management team, generated $980,000 in after-tax earnings annually. On the other hand, Company B, while run by a diligent team, managed only $480,000 in earnings. If you calculate the return on equity, ROE, Company A produced a dazzling 33%, $1,980,000 was $6,000, while Company B managed just 8%, $480,000 was $6,000. Now imagine you're an investor standing at the crossroads of opportunity. Which business would you rather invest in? Seeing business through Warren's eyes. Warren Buffett, one of the world's greatest investors, views businesses much like bonds. He often refers to high ROE businesses as equity bonds, where the annual earnings relative to equity serve as the interest rate. For example, Company A offers an impressive equity bond yield of 33%, while Company B offers just 8%. But unlike traditional bonds, business earnings fluctuate. Warren recognizes this as a form of variable return, which can increase if earnings rise or fall if profits dwindle. What draws Warren's attention to high ROE businesses like Company A is the potential for compounding wealth. Let's explore how this works. The compounding magic of Company A. Suppose you, the proud owner of Company A, decide to reinvest the $980,000 annual profit instead of taking it as a dividend. This decision allows management to reinvest at the same 33% return. In 1 year, the equity grows to $7,980,000. By year 2, this increased equity base generates $633,400 in profits, which gets reinvested again. Fast forward 10 years, Company A's equity balloons to $103,912,407, with projected earnings of $34,000 and $201,000. Compare this to Company B, which, reinvesting at its modest % ROE, grows its equity to just $12,950,000 and earns $36,000 in year 11. This compounding power is why Warren prizes high ROE companies. It's the engine that transforms modest initial investments into extraordinary wealth. Buying a business, the Buffett approach. Let's say you're looking to buy either Company A or Company B. At the time, government bonds offer an 8% return, a safe but modest investment. To match this return, Company A's owner might ask for $24.75 in dollars, 12.5 times earnings, while Company B's owner might settle for $6 million, also 12.5 times earnings. At these prices, both companies offer an 8% return initially, equivalent to bonds. However, Warren doesn't just look at today's return, he focuses on what the company might earn in 10 years. With Company A's 33% ROE, its earnings and equity will grow exponentially. Company B's 8% ROE, by contrast, results in far slower growth. Thus, Company A represents a far superior long-term investment, even at a seemingly higher price. A real-life example. Coca-Cola. In 1988, Warren noticed that Coca-Cola consistently earned over 30% ROE, a hallmark of a fantastic business. He purchased $592.9 million worth of Coca-Cola stock, recognizing its consumer monopoly and remarkable compounding power. Over the next 8 years, Coca-Cola rewarded him handsomely, turning every $100,000 invested into over $900,000, with a compounding annual of 31%. The lesson for investors. High ROE companies with durable competitive advantages, like strong brands or unique products, are rare treasures. Their ability to compound earnings at a high rate over time makes them worth paying a premium. Warren's secret is simple. By focusing on quality businesses that can reinvest profits effectively, he allows compounding to work its magic, turning small investments into legendary wealth. So as you think about your own investments, ask yourself, are you choosing businesses with the power of compounding in their favor? Remember, it's not just about the next year's profits. It's about the journey over the next decade and beyond. A lesson in value, understanding the numbers behind investment. Imagine you're setting out on a grand journey to evaluate an investment, perhaps like examining a mystical creature in a vast, ever-changing economic forest. Before you calculate the potential compounding annual return, pause for a moment. The formulas, equations, and calculations you're about to perform are not an end in themselves. They're like tools in a treasure hunter's kit, each offering a unique perspective on the prize you seek, the earning power of a business. Why is earning power so crucial? Because it's the foundation of predictability, and prediction is the beating heart of investment analysis. As Warren Buffett teaches us, the intrinsic value of a business is the sum of all its future earnings, discounted to the present using a reliable benchmark like government bonds. This isn't a new idea. Buffett credits John Burr Williams and his seminal book The Theory of Investment Value for this insight, which itself traces back to the 1930s work of Robert F. Wees. Yet, even these pioneering minds acknowledged a fundamental truth. Projecting the next century's earnings is an impossible task, even for the savviest analyst. Take a lesson from history. Consider television in the 1940s, an economic curiosity, not much more than a ripple. By the 1970s, it had grown into a golden opportunity, with only 3 major networks dominating ad revenue. Warren himself, in the early 1980s, famously said he'd choose capital cities if he had to invest in one company and vanish to a deserted island for a decade. But by the early 1990s, the television industry was under siege. Cable channels multiplied, fragmenting audiences and ad dollars. The once mighty monopoly faltered. Industries change, and businesses that seem untouchable today may face upheaval tomorrow. Even legendary dynasties like the Medicis and Rockefellers learned this lesson the hard way. The Medici family's Venetian trade monopoly collapsed when the Dutch navigated around Africa, bypassing Venice entirely. Commerce, like nature, evolves relentlessly. And as analysts, we must be realistic. Projecting a company's future earnings across decades involves countless variables and risks. The problem with perfection. Theoretically, summing up all future earnings and discounting them back to today's value makes sense, but in practice, it's fraught with challenges. Growth rates can't remain constant forever. Changing interest rates, taxation, and unpredictable events all conspire to turn precise calculations into educated guesses. Some analysts attempt to address this by dividing the future into 2 growth phases, a high growth period followed by slower growth. Yet, as John Burr Williams observed, even small misalignments between growth rates and discount rates can lead to skewed or nonsensical valuations. The discount rate itself poses another conundrum. Government bonds are often used as the benchmark, but their yields are pre-tax, while corporate earnings are post-tax. This mismatch complicates the calculations. What's more, bond yields and interest rates fluctuate, adding yet another layer of uncertainty. Warren's Way, a practical approach. Buffett simplifies this labyrinth. Instead of forecasting a century ahead, he focuses on the next 5 to 10 years. Using historical return on equity trends and dividend payout ratios, he projects the company's equity value per share at a future date. From there, he calculates the stock's future trading value and determines the expected annual compounding return based on the price paid today. Let's explore this with an example. Berkshire Hathaway in 1986. Back then, its per-share equity value was $2,073, and it had a historical return on equity of 23.3%. Using a financial calculator, you can project its equity value for 1996. Enter $2,073 as the present value, 23.3% as the growth rate, and 10 years as the time period. The future value? a remarkable $16,835 per share. The critical question then becomes, how much should you pay in 1986 for the right to own $16,835 in 1996? If you aim for a 15% annual return, you discount $16,835 at that rate over 10 years. The answer? $4,161 per share. In reality, Berkshire shares were trading for $2,700 in 1986, a clear opportunity for higher returns. Reworking the math shows that buying at $2,700 would yield an annual compounding return of 20%. By 1996, Berkshire surpassed even those expectations, growing its equity value to $19,011 per share, a 24.8% annual growth rate. The market, however, valued Berkshire even higher, bidding the stock to $38,000 per share. If you sold at that price, your 10-year return would soar to 30.2%. The final takeaway. These calculations teach us a valuable lesson. No formula guarantees success, but they can guide your thinking. By understanding a business's earning power and growth potential, you equip yourself to make informed decisions. Remember, though, that markets are unpredictable. A business that seems invincible today may falter tomorrow. But with discipline, patience, and an eye for value, you can navigate this economic forest and perhaps uncover treasures of your own. The Coca-Cola Investment Lessons in Future Value and Compounding Returns. In our journey to understand investing through the lens of Warren Buffett, we've already seen how future value projections can determine the expected returns of an investment. Now, let's take this concept a step further by examining how projected per-share earnings and market price help calculate the potential rate of return. To make this as practical and insightful as possible, we'll delve into a real-world example, Warren Buffett's legendary 1988 investment in Coca-Cola. This chapter is pivotal because it uncovers key insights into Warren's approach, lessons that have eluded many of his followers. By following his reasoning, we'll see how a seemingly simple decision to buy shares of Coca-Cola transformed into a wealth-building masterstroke. 1988. The decision to invest. In 1988, Berkshire Hathaway purchased 113,380 shares of Coca-Cola, $5.22 per share, totaling an investment of $592.5 million. To Warren, each share of Coca-Cola was not just a piece of stock. It was an equity bond with a coupon yielding 36 cents annually. This represented a 33.6% return on Coca-Cola's per-share equity value of 1 to 7 cents at the time. Here's how that 33.6% return broke down. 58% of earnings, at $21 per share, were retained by Coca-Cola, compounding the company's equity value tax-free. 42% of earnings per share were paid out as dividends, subject to personal or corporate taxes. This structure allowed Warren to envision two streams of returns, one reinvested to grow Coca-Cola's equity base, and the other providing a steady cash payout. Compounding growth, projecting Coca-Cola's future. Warren projected that Coca-Cola would maintain a 33.6% return on equity while retaining 58% of those earnings. Using this data, he calculated how Coca-Cola's per-share equity value and earnings would grow over the years. For example, starting with a per-share equity value of $1.07 in 1988, Warren applied the retained earnings growth rate of 19.4%, 58% of 33.6%. In 1989, and $1.194.28 equity value. In 1998, 1.07 compounded at 19.4% for 10 years equals 630's equity value. To find projected per-share earnings, he multiplied the equity value by the return on equity, 33.6%. In 1989, $1.2336 equals 0.443 in 1998, 6.36 equals 2.36. Long-term projections. Confidence in simplicity. Warren's projections for Cocoa spanned 12 years, from 1988 to 2000. While most analysts hesitate to predict more than a year or two ahead, Warren understood that companies with strong earning power and consumer monopolies could sustain long-term performance. Warren then estimated Coca-Cola's market price in 2000 using projected earnings and a price-to-earnings P/E ratio. For a PE of 15, the stock price would be $45.30, and for a PE of 25, it would be 75. Calculating the returns. Starting at $5.22 per share in 1988, Warren's Coca-Cola shares were projected to yield impressive returns by 2000 at $45.30, a 19.7% annual compounding rate, at $75.50 share, 24.9% annual compounding rate. Adjusting for taxes and dividends, Warren still projected after-tax returns ranging from 14.4% to 22%. These returns, he noted, were far superior to any bond offering available at the time. The lesson in numbers. Warren's success with Coca-Cola wasn't a result of luck. It was built on his ability to identify a company capable of compounding earnings at an extraordinary rate. By reinvesting retained earnings into its equity base, Coca-Cola effectively turned shareholder equity into a wealth generation machine. The key takeaway? Long-term projections, when rooted in strong fundamentals, can reveal opportunities others might overlook. As Warren once quipped, things go better with Coke, including your money. Warren's expanding coupon approach to investments. Let me tell you a story about how Warren Buffett views stocks in a unique way, almost as if they're magical equity bonds with expanding coupons. Imagine you're stepping into his shoes for a moment, analyzing one of his legendary investments, Coca-Cola. The equity bond with an expanding coupon. First, a quick primer on where the coupon concept comes from. In the old days, bonds came with physical coupons. You'd clip one, mail it in, and receive your interest payment. Nowadays, bondholders get their payments directly, but the concept remains relevant. To Warren, certain stocks behave like bonds with coupons, except these coupons grow larger each year. Picture Coca-Cola as one of these special equity bonds. When Warren invested in Coca-Cola in 1988, he paid a steep price of $5.22 per share, even though the company's equity value was only $1.07 per share. Why pay so much more? Warren knew something many didn't, the magic of retained earnings and compounding returns. Coca-Cola in 1988, the initial investment. In 1988, Coca-Cola earned 36 cents per share. If Warren had purchased the stock at its book value of $1.07 per share, his return on investment, ROI, would have been a whopping 33.6%. 36.17 equals 33.6%. But Warren didn't pay $1.07. Instead, he paid $5.22 per share, reducing his ROI to 6.89%. 5.22, 6.89%. Why settle for 6.89% when Coca-Cola's equity was earning 33.6%? Here's where Warren's genius shines. He wasn't just looking at the current yield. He was thinking about the future. How Coca-Cola's retained earnings could grow his returns year after year. How retained earnings work their magic. Let's see how this plays out. In 1988, Coca-Cola retained 58% of its earnings, about 21 cents a share, and paid out the remaining 50 cents as dividends. That 21 cents wasn't lost. It was reinvested back into the company, effectively increasing Warren's stake. At the start of 1989, Warren's total investment per share wasn't just the $5.22 he originally paid. It also included the 21 cents in retained earnings from 1988, making his total investment $5.43. Projected investment breakdown for 1989. Original 1988 investment, $5.22. Retained earnings, 1988, plus 21 cents. Total investment, $5.43. Coca-Cola's retained earnings, earning 33.6% ROI, generated an additional 7 cents per share in 1989. Add that to the 36 cents from his original investment, and Warren's total earnings per share for 1989 came to 43 cents. His rate of return? It increased 7.9%, 5.43, 7.9%. Hashed, the power of compounding, 1990 and beyond. In 1990, the retained earnings from both 1988, 21 and 1989, 25, continued working for Warren. Now his total investment per share was $5.68. Let's. Original 1988 investment, retained earnings, 1988 and 1989, plus 46 cents. Total investment, $5.68. The retained earnings from 1988 and 1989 earned at Coca-Cola's 33.6% return on equity, adding 15 cents in new earnings. Combined with the original 36, Warren's total earnings per share for 1990 rose to 51 cents. His rate of return, a solid 8.9%. A 51's a $5.68 equals 8.9%. The lesson: patience and compounding pay off. Here's the takeaway. Warren's initial 6.89% return wasn't impressive on its own, but by staying invested and letting Coca-Cola's retained earnings grow, his rate of return increased year after year. Think of it like buying a bond with a fixed 6.89% return, but reinvesting every interest check into a new bond, paying 33.6%. Over time, the compounding effect transforms a modest return into something extraordinary. It's a strategy that requires patience and confidence in the company's ability to reinvest wisely. But for those who stick with it, the rewards can be exponential. For Warren, investing in Coca-Cola wasn't just about buying a stock. It was about harnessing the power of an expanding coupon, compounding returns, and staying the course. The Tale of Capital Cities, a lesson in projecting investment returns. Imagine you're a treasure hunter, but instead of maps and gold, you're armed with numbers and foresight. Today, let's explore how one can project the future value of a stock and the potential returns it might bring, using the example of a company called Capital Cities. This story isn't just about numbers. It's a lesson in thinking like a savvy investor. Setting the scene. A decade of growth. Between 1970 and 1980, Capital Cities showed remarkable growth in its per-share earnings. These earnings grew from a modest 8 cents to 53, a whopping annual compounding growth rate of about 20%. Such consistent growth hints at a treasure worth exploring. Let's travel forward from 1980 to 1990 and project what might have happened if you had bought a share of Capital Cities in 1980. Could you predict its price in 1990? What might your returns look like? Buckle up and let's dive into the numbers. Step 1. Projecting per-share earnings. Using the annual growth rate of 20%, we can calculate the expected earnings per share EPS for 1990. Here's how. Starting EP at a growth rate 20 times 10 years. With a simple formula or a trusty financial calculator, we get a projected EPS for 1990 of $3.20. This is the first piece of our puzzle. Step 2, estimating the stock price. Next, we turn our attention to the market price of Capital Cities stock in 1990. Historically, the stock traded at price-to-earnings (PE) ratios between 9 and 25. To stay conservative, let's use the low end of this range, a PE ratio of 9. Projected EPS 1993 PE ratio 9. Multiplying these numbers gives us a projected stock price of $29.52 in 1990. Step 3, calculating returns. Now comes the exciting part, figuring out the potential return on your investment. In 1980, you could have bought a share of Capital Cities for $5. If you sold it in 1990 for the projected price of $29.52, what would your annual compounding rate of return be? Using a financial calculator, initial price, PV, $5, final price, FV, $29.52, time 10 years. The result is an annual compounding rate of return of 19.4%. The real story, what actually happened? While projections give us a roadmap, the real journey often brings surprises. By 1990, Capital Cities achieved earnings of $2.77 per share, slightly lower than our estimate of $3.28. But here's the twist. The stock traded at a much higher price range, between $38 and $63 per share. Let's say you sold your stock at $38 in 1990. Plugging the numbers back into our calculation. Initial price, PV, $5. Final price, FV, $38. Time, N, 10 years, your actual annual compounding rate of return would be 22.4%. Had you sold at the high end of $63, your return would have skyrocketed to 28.8%. The bigger picture. This story isn't just about numbers. It's about a mindset. Legendary investor Warren Buffett approaches stocks differently than most. He doesn't obsess over their daily market value. Instead, he asks a critical question. If I buy this stock today, what annual compounding rate of return can I expect over the long term? By focusing on the intrinsic growth of a company and its economic realities, Buffett avoids the noise of Wall Street. He trusts that over time, the market will reflect the company's true worth. A lesson for aspiring investors. If you had invested $100,000 in Capital Cities at $5 per share in 1980, it would have grown to 754,769 by 1990 at a 22.4% annual return. This isn't just a tale of potential riches, it's a lesson in patience, foresight, and understanding the power of compounding. So the next time you analyze a stock, remember the story of Capital Cities. Look beyond today's price. Consider the company's growth, its potential future earnings, and how those earnings might translate into returns. That's how you uncover the true treasure of investing. The Coca-Cola share buyback story. A lesson in economic brilliance. Imagine Coca-Cola as a giant pie that represents the total wealth and value of the company. In 1984, this pie was sliced into 3.174 billion pieces, one for each outstanding share of stock. By 1993, Coca-Cola had reduced the number of slices to 2.604 billion by spending $5.8 billion buying back its own stock. This move shrank the pie's slices, but made each slice bigger. Let's explore how this strategy played out and why it mattered for Coca-Cola's shareholders. The projections versus reality. First, let's look at Coca-Cola's performance from 1989 to 1993. Our projections for per-share earnings were impressively accurate, with almost no margin of error. However, the projected equity values per share didn't match the actual values reported by Coca-Cola. Why? The key lies in Coca-Cola's decision to use its equity to repurchase shares. By reducing the number of outstanding shares, the company increased its earnings per share, EPS, even though the total net income remained unchanged. This had a profound effect on the company's stock market valuation. The mechanics of share buybacks. Between 1984 and 1993, Coca-Cola spent $1.82 per share of its shareholders' equity to buy back stock. Let's see how this affected EPS. In 1993, Coca-Cola's total net income was $2.176 billion. With 2.604 billion shares outstanding after buybacks, the EPS was 0.84. If the company hadn't repurchased shares and still had 3.174 billion shares outstanding, EPS would have been 68 cents. This means the buybacks resulted in an additional 16 cents per share in earnings. But here's where the brilliance lies. The market valued Coca-Cola's stock at 25 times earnings in 1993. That extra 6 cents in EPS translated into a $4 increase in the stock price. In effect, Coca-Cola spent $1.82 to generate a $4 gain in market value per share, a return of over 100% on the investment. The long-term impact. Fast forward to a hypothetical scenario in 2003. If Coca-Cola's net income grew at 15% annually, it would reach $8.403 billion. Here's how the numbers stack up. 1. Without share repurchases. Shares, 3.174 billion. EPS, $2.65. Market price, 66.25 per share. 2. With share repurchases, shares 2.604 billion, EPS 3.23, market price 80.75 per share. The difference? A $14.55 increase in market value, all because of the buyback program. This equates to a compounded annual return of about 15% on the $1.87 per share Coca-Cola spent retiring stock. Why this matters to shareholders? Let's consider an alternative. What if Coca-Cola had paid out the $5.8 billion in dividends instead of repurchasing shares? After taxes, shareholders might have received around $4 billion, or $1.26 per share. While this provides immediate cash, it lacks the long-term compounding effect of the buyback strategy. By letting Coca-Cola reinvest that money into repurchases, shareholders gained bigger slices of the company's pie, increased EPS, higher stock market valuations. The market's reaction. Since Warren Buffett joined Coca-Cola's board and supported its aggressive stock repurchase program, the company's price-to-earnings ratio soared from 18 in 1988 to 40 in 1997. The market rewarded Coca-Cola for its efficient use of capital, recognizing the boost in per-share earnings and return on equity. The lesson for investors. Coca-Cola's buyback story teaches us that financial strategies can amplify shareholder value in unexpected ways. While dividends offer immediate rewards, buybacks create long-term growth by 1. Increasing EPS through fewer outstanding shares, 2. Enhancing market valuations due to higher perceived earnings, 3. Avoiding the tax burden of dividend payouts. For Warren Buffett and other shareholders, Coca-Cola's repurchase program turned a great investment into an extraordinary one. By understanding how the pie gets sliced and shared, investors can better appreciate the power of strategic buybacks in compounding their wealth over time. Understanding growth rates, the tale of two metrics. Imagine you're standing at the crossroads of two paths. One leads to a land of impressive per-share earnings growth, while the other meanders through the less glamorous but honest realm of total net earnings. As an investor, your task is to uncover what lies beneath the surface when a company boasts about its performance. The magic of share count, a Washington Post story. Let's visit 1986, where the Washington Post company stood as a prime example of this dynamic. The company's total net earnings were $100.2 million, and with 12.83 million shares outstanding, each share earned $7.80. Now imagine a clever twist. Reduce the number of shares outstanding to just 10 million. Suddenly, per-share earnings jump to $10.02, even though total earnings haven't changed one bit. This financial sleight of hand showcases how management can manipulate per-share figures to make their performance shine. But remember, it's just optics unless the underlying business engine is driving real growth. Company X, the tale of declining earnings. Now, consider Company X, which starts 1980 with net earnings of $100 million and 10 million shares outstanding, resulting in $10 per share earnings. Fast forward to 1990, net earnings dropped to 75 million, but the share count is halved to 5 million. Per-share earnings rise to 15, a 4.13% annual growth rate, despite an actual annual loss of 2.83% in total net earnings. Management might proudly point to the per-share growth and bask in shareholder applause, but savvy investors will see the truth. The business itself is shrinking, and the growth is merely an illusion created by reducing share count. Raytheon's rocket science, perception versus reality. Let's explore Raytheon, the makers of the Patriot missile. Between 1985 and 1995, their per-share earnings grew at a stellar 11.2% annually, rising from $2.30 to $6.65. But a closer look reveals that net earnings only grew at 7.8% annually, a rate that's respectable but hardly extraordinary. The secret? Raytheon shrunk its share count by 24%, from 155 million to 117 million. It's a neat trick, but one that sharp investors must dissect. Coca-Cola, a story of real and boosted growth. Contrast this with Coca-Cola, where the growth story sparkles with authenticity. Between 1985 and 1995, actual net earnings grew at an outstanding annual rate of 15.2%. But per-share earnings soared even higher at 19.5%, thanks to a reduction in shares outstanding from 3.087 billion to 2.475 billion. Here, the reduction amplified an already stellar performance, a combination of sound business economics and shareholder-friendly policies. The curious case of General Motors. On the other hand, General Motors demonstrates the flip side. From 1985 to 1995, its net earnings grew at an annual rate of 4.82%, but per-share earnings lagged at 2.68%. Why? GM increased its share count from 682 million to 755 million, diluting the per-share figure. This growth stemmed from a growing capital base, not a turbocharged business engine. Banking on capital, the Norwest example. Bank holding companies like Norwest, now part of Wells Fargo, are particularly adept at leveraging share counts. Between 1985 and 1995, Norwest's net earnings grew at a jaw-dropping 28% annually, while per-share earnings grew at 21%. However, the company's outstanding shares ballooned from 178 million to 325 million as it issued stock to acquire other banks. The growth wasn't just from operational success, it was also fueled by savvy capital management lessons from the numbers. As an investor, The lesson is clear. Don't take per-share earnings growth at face value. Always dig deeper to see if the growth comes from genuine business performance or financial engineering. Compare the annual growth rates of actual net earnings and per-share earnings. Look for companies where both metrics align, as that's where the real magic of compounding lies. And the next time a company boasts about its per-share earnings, ask yourself, is this Disneyland where dreams are made, or Wall Street where numbers are reshaped? The Tale of Profits, a lesson in smart decision-making. Once upon a time, in the bustling world of business, there was a company called Company A that found itself with a treasure, $1 million in profits earned in the year 1992. The leaders of Company A sat down to decide what to do with this treasure. Little did they know their choices would echo far into the future. The restricted and unrestricted treasure. First, the leaders recognized that not all their profit was free to spend as they wished. A portion had to be set aside to keep their business running smoothly. For instance, in 1993, they knew their main plant's generator needed replacing, a task costing $400,000. Without this generator, their operations would halt. So they wisely allocated $400,000 from their 1992 profits to this purpose. This part of the treasure was known as restricted earnings, profits reserved for essential reinvestments. The remaining $600,000 was unrestricted, a pool of funds available for other ventures. This was where the true challenge began. How should they use this unrestricted treasure to bring the best value to their shareholders? The two paths. The leaders of Company A had two choices. One, distribute it as dividends. Hand the $600,000 directly to shareholders, letting them invest it themselves. Bummer two, reinvest it. Use the funds to grow the company, either by exploring new ventures or repurchasing shares. Enter Warren, a wise investor who believed in making every dollar work harder. He suggested that management should keep the unrestricted earnings only if they could generate a better return than shareholders could achieve on their own. For example, if Company A could invest the $600,000 to earn a 15% annual return, while shareholders could only earn 10% elsewhere, it made sense to reinvest. However, if the company could only generate a 5% return, while shareholders could earn 15% on their own, paying out dividends would be the wiser choice. The mystery of management skill. But here's where things got tricky. As investors like Warren assessed companies, they faced a dilemma. How could they measure whether management was wisely reinvesting unrestricted earnings? It was a challenge obscured by two key factors. One, core business strength. A thriving business could produce so much cash that it masked poor decisions by management. Two, inflation. Rising prices could inflate earnings, making management appear more competent than they truly were. Investors needed a way to cut through the noise and evaluate performance objectively. A simple test. Warren's approach was elegant. Compare the earnings retained by the company over a period to the increase in per-share earnings during that time. Let's dive into some examples to see this in action. 1. Coca-Cola, 1983-1993, retained earnings, 2.55 cents per share, increase in per-share earnings, 6.67 cents, return on retained earnings, 26.2. Coca-Cola's management showed brilliance in reinvesting retained earnings to generate exceptional returns. 2. General Motors, 1983 to 1995. Retained earnings, 26.27 cents per share, increase in per-share earnings, 136 test. Return on retained earnings, 5.1%. Despite holding on to a significant amount of earnings, GM delivered minimal growth, highlighting challenges in the auto industry. 3. Cray Research, 1983 to 1993. Retained earnings, $31.67 per share. Increase in per-share earnings, 144. Return on retained earnings, 4.5%. Cray struggled to generate strong returns despite reinvesting all its earnings. 4. Gannett Corporation, 1983 to 1993. Retained earnings, 10.51 cents per share. Increase in per-share earnings, $1.59. Return on retained earnings, 15.1%. Gannett's strategic reinvestments created meaningful shareholder value. The moral of the story: By comparing retained earnings to the returns they generate, investors can gauge how effectively a company uses its profits. Coca-Cola and Gannett shone as examples of skillful management, while General Motors and Cray Research highlighted the importance of strategic decision-making. This simple framework empowers investors to separate the true stewards of capital from those merely riding the tide of a strong core business. In the end, the story teaches us that how profits are used is just as important as earning them. And for Warren, the greatest treasures were those managed with wisdom and care. Warren Buffett's hidden talent, mastering the art of arbitrage. Once upon a time, in the ever-changing world of investments, a young Warren Buffett discovered an intriguing talent that would complement his mastery of long-term investing. While Warren preferred the steady, predictable path of long-term value investments, he realized that during times when such opportunities were scarce, there was another way to put idle cash to work: arbitrage, or as Warren affectionately called it, workouts. The hidden art of arbitrage. Arbitrage, or workout opportunities, arise in special situations: corporate mergers, spin-offs, reorganizations, liquidations, and hostile takeovers. Imagine a company announcing its decision to sell or merge with a fixed future price for its stock. The magic of arbitrage lies in the spread between the current stock price and the future sale price. If done wisely, this gap could yield a handsome profit. For example, if Company X announces it will sell its stock at $120 per share in 6 months, but the market currently prices it at $100, an arbitrageur buying the stock at $100 stands to gain $20 per share when the deal closes. The challenge? Timing. The longer the wait, the lower the annualized return. A quick close in 6 months could mean a 40% annualized return, but a delayed close in 2 years might slash it to 10%. Warren understood this balance between time and return better than most. Over 30 years, his arbitrage investments consistently yielded a pre-tax annual return of around 25%, a remarkable feat by any measure. In the early days of the Buffett partnership, up to 40% of the partnership's funds might be allocated to arbitrage situations, especially during downturns when the broader market was floundering. For instance, in the bleak year of 1962, while the Dow dropped 7.6%, the profits from Warren's arbitrage deals kept his partnership afloat, delivering a 13.9% gain. Mechanics of success. Warren was meticulous in his approach to arbitrage. Drawing from the teachings of his mentor, Benjamin Graham, and Graham's formula for calculating risk and reward, Warren approached each deal with precision. One illustrative example was his 1982 investment in Bayuk Cigars. After the company announced the sale of its assets and plans to liquidate, Warren saw an opportunity. The market priced Bayuk's shares at $5.40, but the liquidation was projected to pay shareholders $7.87 per share. The potential profit of $2.43 per share seemed enticing, but Warren applied Graham's formula to ensure the reward justified the risk. He calculated expected gain G, $2.43 per share, expected loss L, $0.94 per share, if the deal fell through and shares returned to pre-announcement levels. Chances of success C, 90%, given the deal had Justice Department approval. Holding period Y, 1 year, current price P, $5.44 per share. By weighing the probabilities of success and failure, Warren determined his annualized return for the Bayuk deal would be 38 cents, a stunning figure for a short-term investment. Lessons from the arbitrage king. Warren's approach to arbitrage is rooted in discipline. Unlike many Wall Street speculators who chase rumors of potential takeovers, Warren sticks to announced deals. Why? Because the certainty of an announcement reduces the risk of failure, a principle Warren cherishes. He knows that a sure 25% return beats the allure of a maybe 100%. Arbitrage also thrives in volatile markets. When the stock market declines, companies are often more willing to sell or reorganize, creating a fertile ground for arbitrageurs. For Warren, these moments are opportunities to gain a competitive edge. The wisdom of Graham. The foundation of Warren's success in arbitrage lies in Graham's teachings. Graham, inspired by the 1931 treatise Arbitrage in Securities, recognized that large profits could be made when the price spread between the market price and the announced deal price was significant. He developed a formula that factored in expected gain, loss, probability of success, and holding time. Warren internalized this method, using it to evaluate hundreds of deals from RJR Nabisco to General Dynamics. A reliable compass in uncertain waters. In arbitrage, time is as important as money. Every deal comes with risks, delays, government interference, or outright cancellation. Warren mitigates these risks by sticking to announced transactions and carefully calculating potential returns. His approach exemplifies the balance between caution and ambition, showing us that even in the short term, patience and precision can yield extraordinary results. And so, Warren's hidden talent became not just a fallback strategy, but a masterclass in how to turn the unpredictable into the profitable. For investors willing to do the work, Warren's arbitrage lessons remain a timeless guide in the art of calculated risk-taking. The Gannett Investment Story, Lessons from Warren Buffett's Strategy. Let's dive into a story that combines numbers, wisdom, and a bit of detective work, all inspired by Warren Buffett's 1994 investment in Gannett Corporation. Think of this not as a dry analysis, but as a lesson-filled journey into how one of the world's greatest investors makes decisions. The spark of interest. Imagine young Warren Buffett as a boy delivering newspapers on his Washington Post wrote. It's easy to see how his love for the media business began. Fast forward decades, and that boy became a savvy investor with a knack for spotting great companies in industries he understood deeply. In 1994, his attention turned to Gannett Corporation, a newspaper holding company that also owned USA Today, a national publication everyone recognized. Buffett wasn't just buying stock, he was buying a story, a strategy, and a steady stream of earnings. Step 1. Investigative work. When Warren looks at a company, he puts on his detective hat. For Gannett, here's what he uncovered. 1. Dominance in local markets. Most of Gannett's newspapers were the only game in town. Less competition, more profits. 2. Recognizable brands. USA Today wasn't just any newspaper, it was the one you grabbed in an unfamiliar airport because it covered national news, not local happenings. 3. Diverse media assets. Beyond newspapers, Gannett owned radio and TV stations, providing multiple revenue streams. These clues told Warren that had strong consumer loyalty and stable business foundations. Step 2. Testing the business. Buffett's process is like a litmus test for businesses. Here's how Gannett scored. Consumer monopoly? Check. Many Gannett papers faced little to no competition in their local markets. Understandability? Double check. Newspapers and TV stations are simple, familiar businesses. Conservative financing. With earnings strong enough to pay off all debt in just 2 years, Gannett was solid. Earnings growth. A decade of consistent growth, despite 2 tough years in a media recession, showed resilience. Smart capital allocation. The company reinvested earnings wisely, bought back shares, and boosted shareholder value. Pricing power. Newspapers can adjust prices for inflation without losing much business, especially when they dominate the market. By the end of this test, Gannett had passed with flying colors. Step 3. Crunching the numbers. Here's where Buffett's calculator and a clear investment framework came into play. Initial rate of return. At $3.20 per share earnings and a 7% government bond rate, Gannett's stock was worth $45.71 if treated as a bond. Buffett paid an average of $48.90, a fair price for a business with growth potential. Earnings growth projection. Gannett's per-share earnings had grown 8.6% annually for the last decade. This growth suggested the stock's coupon would outpace government bonds. Return on equity. With a stellar 20.4% average over 10 years, Gannett's management proved adept at reinvesting profits profitably. Step 4. Forecasting the future. Buffett didn't stop at today's numbers. He looked 10 years ahead. Equity growth. By 2004, Gannett's per-share equity was projected to grow from $13.04 to $41.37 at a 12.24% annual rate. market price. At a conservative price-to-earnings ratio of 15, the stock could be worth $126.60 by 2004. At a higher ratio of 23, it might hit $194.12. Total returns. Adding dividends, Buffett estimated a pre-tax annual compounding rate of return between 10.55% and 16.12%. In simple terms, Buffett saw Gannett as a machine that turned $1 today into at least $2.73 and possibly as much as $4.29 in a decade. Lessons learned. What can we learn from Warren's investment in Gannett? Understand what you own. Buffett knew the media business inside out. He didn't gamble on uncertainty. He invested in familiarity. 2. Focus on fundamentals. Strong earnings, conservative debt, and smart management are timeless indicators of a good company. 3. Think long-term. Buffett didn't buy Gannett for a quick flip. He saw it as a 10-year journey of compounding value. 4. Price matters. Even a great business isn't a buy at any price. Buffett carefully calculated whether Gannett was worth its market valuation. The outcome. By 2004, Buffett's $335 million investment in Gannett had the potential to grow to nearly $1.5 billion. It wasn't just about the money. It was about sticking to principles, applying patience, and watching the power of compounding work its magic. For those seeking to emulate Buffett, the Gannett story teaches this. Master the art of evaluating businesses, think long-term, and never underestimate the value of a well-chosen investment. A lesson in investing, Warren Buffett's 1992 Freddie Mac adventure. Let me take you on a journey into the mind of one of the most successful investors of all time, Warren Buffett, as we explore his 1992 investment in the Federal Home Loan Mortgage Corporation, better known as Freddie Mac. This story is not just about numbers. It's a masterclass in understanding the fundamentals of a business and the art of value investing. The role of Freddie Mac. Imagine you're buying a house and take out a mortgage with your bank. Your bank doesn't just hold on to that loan, it likely sells it to Freddie Mac. Freddie Mac then bundles this mortgage with thousands of others into what's called a mortgage-backed security. These securities are sold to institutional investors who earn returns from the interest you and others pay on your mortgages. This system allows banks to free up cash to issue more loans, ensuring the housing market keeps moving. The opportunity. Freddie Mac began publicly trading in 1988. By 1992, Warren Buffett, through his company Berkshire Hathaway, had already acquired 4% of Freddie Mac. That year, with the company's stock trading near lifetime highs, Buffett decided to increase his stake, purchasing an additional 8.7 million shares for $337 million at an average price of 38.68 cents per share. This brought Berkshire's total ownership to 9% of Freddie Mac. What made Buffett confident in this move? To answer this, let's step into his shoes and evaluate Freddie Mac using his investment framework. Detective work. Analyzing Freddie Mac. Buffett's process involves answering a series of critical questions about a business. 1. Does the company have a consumer monopoly or a competitive advantage? While mortgages themselves are commodities, Freddie Mac's unique position as a government-sponsored enterprise gave it a quasi-monopoly. Along with Fannie Mae, it dominated the market for mortgage-backed securities. 2. Is the company conservatively financed? Freddie Mac's liabilities were offset by highly liquid assets, mortgages. While not traditionally conservative, its government backing provided a safety net in times of trouble. Defaults on underlying mortgages posed a risk, but Congress had historically stepped in to stabilize the housing market. 3. Are the earnings strong and trending upward? Freddie Mac's earnings were on a stellar growth trajectory, compounding annually at 17.66% between 1986 and 1992. Here's the year-by-year snapshot of earnings per share, EPS. Year, EPS, 1986, 124, 1987, 1988, 1989, 1990, 1991, 1992, 329. Consistency in earnings growth is a hallmark of a reliable business. 4. Does the company reinvest retained earnings wisely? Freddie Mac retained $11 per share in earnings from 1986 to 1992. This reinvestment led to a 2.5% increase in per-share earnings, reflecting an 18.6% return on retained earnings. 5. Is management efficient? Freddie Mac's return on equity, ROE, averaged 22.3% over 6 years, far exceeding the average corporate ROE of 12%. High and consistent ROE is a sign of capable management. 6. Is the business insulated from inflation? Inflation generally raises housing prices, which leads to larger mortgages and consequently larger profits for Freddie Mac. Number 7. Does the business require minimal capital expenditures? Freddie Mac's operations didn't rely on expensive plants or equipment. Its expansion required little capital, allowing most profits to flow to shareholders. The price matters. Buffett doesn't buy just because a company is great. The price must be right. Let's consider the numbers. Earnings yield in 1992. With EPS of 3.29 cents and a stock price of 38 6/8, the earnings yield was 8.5%, higher than the long-term interest rate of 7.39%. Projected returns. Using historical growth rates, Buffett estimated that by 2002, Freddie Mac's stock could trade $150 and $214 per share, translating to an annual compounding return of 16.32% to 21.85%, including dividends. For comparison, a 1992 government bond offered a static 7.39% return. Freddie Mac's stock, with its higher yield and potential for growth, was a far more attractive investment. Key takeaways. Warren Buffett's 1992 investment in Freddie Mac is a timeless example of disciplined investing. 1. Understand the business. Buffett identified Freddie Mac's quasi-monopoly and predictable growth in earnings. 2. Assess the numbers. He evaluated its earnings growth, return on equity, and dividend potential. 3. Price determines value. Even a great business is not worth buying at an inflated price. Buffett bought only when Freddie Mac's stock offered a compelling return. The lesson for us. The story of Freddie Mac in 1992 teaches us to look beyond hype and headlines. A great investment requires digging deep, understanding the economics of a business, and ensuring the price is right. Whether you're investing in stocks or starting a business, these principles remain as relevant today as they were in 1992. The McDonald's story, a lesson in investment through the eyes of Warren Buffett. Let's go back to 1996, a time when hamburgers weren't just fast food, but a cultural phenomenon. For decades, McDonald's Corporation had been serving up more than just meals. It had become a global icon of consistency, convenience, and consumer loyalty. That year, Warren Buffett saw an opportunity, and Berkshire Hathaway acquired over 30 million shares of McDonald's at an average price of $41.95 each. Why did Warren see such value in a burger chain? Let's break this down step by step and learn the lessons hidden in McDonald's golden arches. 1. The power of a brand. McDonald's isn't just a restaurant. It's a brand recognized worldwide. The sheer scale of its operations, over 20,000 restaurants in more than 100 countries, made it a household name. With a customer monopoly built on its famous Big Mac, Golden Fries, and Happy Meals, McDonald's wasn't just selling food, it was selling familiarity and trust. This strong consumer monopoly gave the company an edge over competitors and protected its market share. Lesson. A strong brand can create a consumer monopoly, insulating a business from competitors and economic downturns. 2. Financial prudence. A quick look at McDonald's balance sheet revealed conservative financing. Long-term debt accounted for just 35% of its capital structure, a manageable level, especially given the company's consistent earnings. Warren liked this kind of prudence. It meant the company was unlikely to falter under financial stress. Lesson. Conservative financing reduces risk and enhances stability, a key trait of long-term investments. 3. Earnings that grow and show. McDonald's earnings demonstrated consistent growth, from $1.62 per share in 1986 to $2.21 per share in 1996. Company's annual earnings growth rate averaged 13.5%. This upward trend reflected a business model that could scale and deliver predictable results. Lesson. Look for businesses with strong, growing, and consistent earnings. These are the bedrock of a good investment. 4. Strategic use of retained earnings. McDonald's management excelled in reinvesting profits. Between 1986 and 1996, retained earnings of $11.48 per share contributed to an earnings increase of $1.50 per share, yielding a return of 13.8%. This reinvestment not only grew the company's earnings, but also drove up the stock price. Lesson: smart reinvestment of profits can multiply value for shareholders. 5. High returns on equity. McDonald's delivered an average return on equity, ROE, of 18.25% over a decade, well above the corporate average of 12%. Consistently high ROE indicates efficient management and strong business fundamentals. Lesson: a high and stable ROE is a hallmark of a profitable and well-managed company. 6. Inflation? No problem. McDonald's had the flexibility to adjust its prices in response to inflation. While a burger once cost 15 cents, prices had risen without deterring customers. This pricing power allowed the company to maintain profitability, even as costs increased. Lesson: businesses that can pass on costs to customers without losing demand are resilient to inflation. Minimal capital expenditures. Unlike industries that demand constant investment in new technology or facilities, McDonald's required minimal capital expenditures. Franchisees bore much of the cost of building restaurants, freeing the corporation to focus on growth. Lesson: low capital expenditure requirements can enhance profitability and reduce financial strain. The price is right. When Warren purchased McDonald's shares in 1996, he calculated the intrinsic value based on expected returns. The stock offered an initial rate of return of 5.2%, with the potential for growth at an annual rate of 13.5%. Comparing this to a static 7% return on government bonds, McDonald's stock stood out as the better investment over the long term. By 2006, projections suggested McDonald's per-share earnings could grow to $7.81, with a corresponding stock price of $113.42, based on a P/E ratio of 16.7. Including dividends, Warren anticipated a total return of 0.6% to 14.6% annually. Lesson: patience and a long-term perspective can turn calculated risks into compounded rewards. Takeaway: Warren Buffett's investment in McDonald's wasn't about loving hamburgers. It was about loving a business with a strong brand, consistent earnings, high returns on equity, and prudent financial management. By understanding these principles, you too can spot opportunities where others see ordinary businesses. As McDonald's showed us, even a simple burger can yield extraordinary results. The Billionaire Blueprint, a story of strategy and teaching. Once upon a time, there was a curious investor who dreamed of becoming a billionaire. The investor had heard whispers of a legendary figure named Warren Buffett, a man who had unlocked the secrets to compounding wealth. With a heart full of ambition and a mind eager to learn, the investor decided to embark on the journey of understanding Buffett's methods. The first lesson was clear. Patience and strategy are the keys to compounding wealth. By adopting Buffett's investment approach, the investor could expect annual returns of 15 to 25% compounded over decades. But when the investor calculated what that meant, starting with $1 million, it became apparent that even after 30 years, the most they might achieve was $807 million. Close, but no billion-dollar cigar. Wait a minute, thought the investor. This is supposed to be a guide to becoming a billionaire. Indeed, it was. But the journey required learning one critical piece of the puzzle. To truly scale your wealth to billions, you need to invest other people's money. Starting the billionaire's path, the limited partnership. To illustrate the point, let's turn the clock back to 1956, when a young Warren Buffett returned to Omaha armed with the wisdom of Benjamin Graham and an unrelenting drive. Warren chose a simple yet powerful tool to begin his billionaire journey: the limited partnership. Why a limited partnership? It offered freedom from heavy regulatory oversight as long as the number of investors remained under 100. It also allowed Buffett to set his own terms for fees and profit sharing, giving him a flexible way to attract investors while maximizing profitability. With this vehicle, Buffett created Buffett Associates Led, with 7 partners who collectively contributed $105,000. This certificate of limited partnership laid out the ground rules for how profits would be shared and how the partnership would operate. From 1956 to 1962, Buffett didn't stop at one partnership. He created 9 more, raising capital from friends, family, and anyone he could inspire with his vision. Eventually, he consolidated these into Buffett Partnership Limited, amassing 98 limited partners and over $10 million in capital. The terms were fair but strategic. Warren took 25% of any profits above a 6% threshold, ensuring investors earned more than what they could get from a savings account before he took his share. The art of attracting investors. How did Buffett convince people to trust him with their money? By starting with those closest to him. His first investors were family and friends. As his reputation grew, he expanded his circle, hosting casual gatherings where he shared his insights. Over chicken dinners at places like Rose's Lodge, Buffett captivated potential investors, especially professionals like doctors who had substantial disposable income. He understood an essential truth. The quality of your investors matters as much as their quantity. As his partnerships flourished, Buffett raised the minimum investment threshold to attract the wealthiest and most serious partners. Scaling to billionaire heights. The insurance move. By the mid-1960s, the stock market became overvalued. Buffett, ever the opportunist, decided to close his partnership rather than pursue strategies he didn't believe in. He waited patiently until the market corrected itself and began buying undervalued companies. One of these was a struggling textile business called Berkshire Hathaway, which Buffett initially saw as a bargain. But when the textile business faltered, Buffett pivoted. Instead of pouring money into new equipment, he used Berkshire's capital to acquire an insurance company, National Indemnity Insurance. Why insurance? Buffett had discovered a golden goose, the float. Float refers to the money insurance companies collect from premiums which they hold until claims are paid. This money could be invested in the meantime, essentially giving Buffett billions of dollars to invest without borrowing a cent. By 1996, Berkshire's insurance operations had generated a float of $6.7 billion, money Buffett used to fuel his ever-expanding empire. The formula for billionaire success. So, how does one follow Buffett's path to a billion-dollar fortune? Here's the playbook. 1. Master the art of investing to achieve a compounded annual return of 23% or better. 2. Start a limited investment partnership, offering terms that attract serious investors. 3. Inspire trust and confidence among wealthy individuals by sharing your vision and track record. 4. Leverage your profits to acquire strategic businesses, especially those with sustainable cash flows. 5. Gain control of an insurance company to access its float and invest it wisely. But there's a twist. To gain full control of an insurance company, you must ensure your friends buy the remaining 2% of the stock, giving you effective control of 51%. This final piece solidifies your control while keeping regulatory concerns at bay. The lesson: achieving billionaire status isn't just about making money. It's about understanding how to scale wealth through strategy and foresight. Buffett's genius wasn't just in picking stocks, it was in creating structures that amplified his returns using other people's capital. For the investor who dreams big, Buffett's path serves as both a roadmap and a reminder. With patience, discipline, and a bit of ingenuity, even the loftiest goals can be achieved. Had a lesson in investing. The tale of 54 gems. Imagine yourself as an explorer standing at the edge of a vast forest. The trees represent the thousands of companies publicly traded on the stock market. Somewhere within this forest lies treasure, excellent businesses. These businesses, if found, could offer immense rewards to the patient and wise investor. But how does one navigate such an overwhelming expanse without getting lost? To save you time and effort, consider this tale of 54 companies. These are businesses that investing legend Warren Buffett has kept an eye on over the years. These companies, hand-picked from the forest of the market, are what we call gems. Now, before we dive into the list, here's a crucial lesson to keep in mind. The market is a moody creature. On some days, it's wildly optimistic about these companies and prices them high. On other days, it's deeply pessimistic and prices them low. The secret to successful investing lies in waiting for those gloomy days. On such days, the market's mood swings present these gems at bargain prices. Two kinds of gems. As we study these companies, let's understand their nature. We can classify them into two types. 1. Consumer monopolies. These are companies with a strong brand presence. Examples include Coca-Cola, with products so well loved they dominate their markets. 2. Toll bridges. These are businesses that provide essential services other companies must use to operate. Examples include advertising agencies and financial institutions. Sometimes, a company may blur the lines and exhibit traits of both. The 54 companies. Here's the treasure map to Warren Buffett's world of investments. Consumer monopolies. American brands, American home products, Anheuser-Busch, Bristol-Myers Squibb, Campbell Soup, Coca-Cola Co., Gillette, Hershey Foods, McDonald's Corp., Nestle S.A., PepsiCo Inc., Philip Morris, Ralston Purina Group, Seagram Co., Tiffany & Co., UST Inc., Toll Bridges, Advo Inc., Bear Stearns, Dean Witter, Discover & Co., Interpublic, Lucadia National, MBIA Inc., Merrill Lynch & Co., Morgan Stanley Group, Thomson Corp. Blurring the lines. Some companies are both consumer monopolies and toll bridges. BHC Communications, International Flavors and Fragrances, New York Times, Times Mirror, Media General Inc., Special Mentions, Federal Home Loan Mortgage Corporation, a unique toll bridge. Washington Post and Wells Fargo, dependable toll bridges with strong reputations. The key lesson. Every great investor knows patience is a virtue. As you review this list, remember, these companies may not always be attractively priced. Your job is to wait for the days when the market's mood dips low. On those days, these treasures of the market may be available at a discount. Much like the explorer who waits for the right moment to strike, the wise investor bides their time, keeping an eye on the map. Only then will the treasures of the market be ready to be claimed. The Art of Patience, Lessons in Investing from Graham and Warren. Once upon a time, in the bustling marketplace of Wall Street, there lived a young investor named Alex. Like many who wandered the labyrinth of stocks, Alex was eager to strike it rich, lured by stories of fortunes made overnight and equally dramatic tales of ruin. He marveled at the meteoric rise of certain stocks, yet was equally puzzled by their sudden falls from grace. The market, as unpredictable as the sea, tossed Alex between fear and greed, leaving him adrift. One day, Alex encountered a seasoned investor named Graham, known for his wisdom and calm demeanor. Graham often quoted the Roman poet Horace, "Many shall be restored that now are fallen, and many shall fall that now are in favor." It was a reminder that the tides of fortune are ever-changing, and that only a steady hand could navigate the turbulent waters. Alex was curious and eager to learn, so Graham shared a tale about another disciple of his teachings, a young man named Warren. Warren, Graham said, was a patient man. He understood that the key to success was not in chasing every wave, but in waiting for the perfect opportunity to strike. Warren, as the story went, had found his guiding philosophy in Graham's teachings, to view investing through the lens of business perspective. This mindset gave Warren the courage to endure the storms of falling markets and the discipline to resist the frenzied greed of a bull run. Graham continued, "Imagine you're at bat in a game of baseball. The pitcher hurls one ball after another, but you don't have to swing unless you see the perfect pitch." Warren understood this. He'd wait, sometimes for years, for that one pitch that fit his criteria, and when it came, he'd swing with all his might. Alex listened intently as Graham painted vivid pictures of Warren's patience. Warren once waited through a long stretch when the market offered notable opportunities. People thought he was foolish for not swinging, but Warren remained steadfast. Eventually, when the market crashed and stocks were undervalued, he was ready. He made his move, investing in companies like the Washington Post, and the results were legendary. Another home run for Warren and a massive win for his company, Berkshire Hathaway. Alex was amazed. "But what about the urge to act quickly?" he asked. "What if I inherit money tomorrow? Wouldn't it be foolish to let it sit idle?" Graham smiled knowingly. That's the challenge, he said. Patience isn't easy, especially when the world around you is moving at lightning speed. Most people feel compelled to act, to invest, to keep the money working. They chase trends, abandon strategies, and end up scattered and directionless. It's like trying to build a house but switching architects and blueprints every month. You'll never finish anything meaningful. He shared another lesson. Investment strategies are like mastering a craft. If you're training to be a doctor, you can't suddenly decide to be a lawyer because it looks more lucrative, then switch to business because MBAs are making headlines. Success requires focus, consistency, and time. Graham explained how even Warren had faced moments of doubt. In 1971, when the market soared and bargains were scarce, Warren closed his investment fund rather than compromise his principles. He waited, watching as others rode a wild bull market. Then came the crash, and Warren, ready and prepared, made some of the greatest investments of his career. As Graham's story unfolded, Alex began to see the wisdom in waiting for the perfect pitch. So, I need to stick to a strategy, Alex said, to trust it even when the world seems to be shouting otherwise. Exactly, Graham replied. Patience and discipline are rare virtues, but they're the foundation of great investing. When fear grips the market and others panic, you'll see opportunity. When greed blinds others to risk, you'll hold steady. From that day forward, Alex resolved to embrace patience. He would wait for the market to offer its gifts, guided not by the whims of the crowd, but by sound judgment and the timeless wisdom of Graham and Warren. In doing so, he knew he was not only investing in stocks, but in his own growth as a disciplined and wise steward of wealth.